both to their share price, but also to others. Hermes, for example, we're set to hear from Hermes a little bit later on this earnings season. Ericsson also could be in focus this morning. The telecom equipment company profits from networks adjusted operating margin, more than 20%, and that seems to be higher than the market had anticipated. So this could be one that goes higher. With all that said, though, I mean, we could have put all things on this list, Guy. Pharma, chips, everything. We'll watch how it all responds to the latest news flow.
Absolutely, and when does that news flow come? Right, time for the market open, time for the opening trade. Europe used to be all about luxury stocks. Now it feels like it's all about defence stocks. We're going to compare and contrast maybe the CAC 40 and the DAX today. Look at what Rheinmetall's doing. CAC, we'll wait for that to open. We'll wait for the DAX to open. We've got the FTSE 100 out of the gate early, as always. It is up by 0.1%. The Stock 600 is up by 0.2%. How quickly will we get the bid offer close to open? LVMH today. What happens with Hermes? Remember, it's got numbers out on Thursday. L'Oreal's got numbers out on Thursday. Got Moncler out this week. There's a lot going on in that space as well. The IBEX is out. It's up by 0.4%. So a cautious start, I would argue, this Tuesday morning. Can we call that calm? I don't know. Critty, what's going on below the surface?
We're seeing a little bit of a mixed picture when it comes to below the surface. Right out of the gates, we're seeing the likes of ASML really lead this market higher when it comes to this index contribution. In the FTSE 100, a similar story as well, where some of your traditionally defensive stocks are leading this rally. Healthcare is, however, on the back foot. I am seeing several of these names take a little bit of a beating, from the likes of Roche, for example, to the likes of Sanofi. And even the French stocks also feels like taking a little bit of their messaging from the numbers we got from LVMH as well. So, Anna, almost a little bit of the expected, but also a little bit of a mixed bag.
We do see some of the sector breakouts that we'd expected. So technology, that's an area of focus. Autos and parts is the one I wanted to mention, up by 1.8% this morning. We've got the likes of Valeo going higher, Stellantis going higher. That's up by 4.6%. So we did see some of the automakers over in the United States going higher on the back of Trump's latest comments, suggesting perhaps some kind of reprieve around some of the tariff situation for autos. And of course, Stellantis has a substantial presence in the United States, so it makes sense that that one is more volatile in the face of that kind of news. Consumer products and services then is the weakest sector, and that speaks to the luxury news. We've got Kering there, Christian Dior, Moncler, Hermes, L'Oreal, Bruno Cucinelli, Burberry. They are all down by more than 2%. Richemont not far behind. So we're certainly seeing some weakness coming through on that particular sector.
I think UBS is XD today, isn't it?
Yes.
That's probably one of the reasons why. Yeah. So UBS is XD. Yeah, you've still got L'Oreal and Hermes are the two biggest points drops in the luxury space this morning, right now at the top of my board. Both of these companies still have to report numbers. How much of a predictor is LVMH in terms of what we're going to see with some of these other names? Does Hermes still have pricing power in the way that LVMH doesn't?
Yeah.
The further up you go up the income scale, do you get less volatility maybe around some of the earnings? I keep coming back to it. The Birkin handbag is a Veblen good. It's almost price irrelevant. The long list times, the long lead times in terms of production, huge lists in terms of getting hold of these things. Does that protect that company? How much titration difference are we going to see in that space?
Absolutely. And we should mention that LVMH is actually still halted. So all the indications that we're getting from some of these other kind of players in the luxury space of something like 3-4% declines, perhaps early indications of some of the pain we might see in the likes of LVMH. All right, so what do you do when you don't know what to do? We got to ask John White, founder of European long-short hedge fund Calibrate Partners, joining us around the table. And John, as we literally come to you, I'm seeing the DAX open higher by 0.6%. The French index is not open just yet. But again, it comes down to this idea of we keep going back and forth. What do you do when you don't know what to do?
You guys always ask great questions.
What are you doing?
Well, I think, when you're a bit unsure, I think your starting point is you probably do a bit less. But whenever I've seen, in my experience, seen markets go through these types of shocks, they generally land in a place where investors are happier to own stocks and companies where you have more certainty over the earnings visibility 1 year, 2 years out. So there are plenty of companies across Europe where we've got, good visibility of earnings, less volatility of earnings, 1 year, 2 year out. So through the summer, I suspect that a lot of these stocks will grind higher as the market gives them a higher multiple. And I think the reverse is true, where we have companies with less visibility. The PEs will contract. So I think that's probably the theme through the summer. And that's certainly how we're playing it.
All right, so that the PEs will contract, but I'm curious if there's hesitation, at least you're seeing early hesitation in terms of things like CapEx spending. We had a guest on yesterday talking about the suspension of buybacks as kind of the big tell for more downside in this market. What's the tell for you?
Well, I think we sort of, if I think about the big building blocks of what we're seeing at the moment, and obviously Trump and tariffs are front and centre, but it might not be the right thing to be focusing on through the summer, because it's clear that there's a feedback loop in process. I mean, for example, we've seen the road back on car tariffs overnight, and I'm sure that's linked to the fact that VW, for example, has 2 months of supply, US supply, just docked at various ports around the US, and that just creates all sorts of unintended consequences. So the feedback loop, I think, works. I'm slightly more interested in China's reaction to lots of these policies, because that's more difficult to read. And then when you think about Europe, Europe could be the relative winner in all of this, because it's clear that Europe has been forced into a set of behaviours that we probably wouldn't have scripted a year ago. I mean, the German fiscal change was something that, I think the size and magnitude of that, the defence spend that we've seen, is something that is a bit shock and awe. And I suspect the big call for the next, 6 months in Europe is going to be a Eurobond, and I think that will be linked to banking regulation. I think it will be linked to banking consolidation, and I think that will be the key.
Okay, so long banks, defence stocks presumably on the back of that. If you're looking for a sector that's got visibility, I'm presuming defence has it right now.
Yes.
At the other end, what doesn't have visibility? Is it the auto sector? Is it the chip space? So you've got two buckets. You've got the visibility, no visibility.
Yes.
And kind of what goes into both buckets?
Well, I think you could probably put LVMH in one of those buckets.
Which one is it?
As we've seen overnight. And I think, when you look at LVMH, it's an incredible brand, and it's an incredible group of brands, and it's an incredible business, and it's incredibly well run, and it's incredibly global in scale. So, whenever you've got a trade war, the likes of which we have, it's clearly going to be difficult to run that business through this type of environment. And remember, COVID wasn't that long ago, so these companies were over-earning for a long period of time, and I think people forget that. So, we've come off the back of these huge retained earnings or retained cash flows that consumers had through COVID, particularly in the US, which is the biggest market for LVMH. And now things are normalising, and you've got a trade war, and it's difficult to manage any business, but to manage, a business that is really, buying goods and services from China and selling them to the US. That's a pretty difficult place to be.
Yeah. And John, so all that we talked about has been kind of sectoral, I suppose, rather than geographic. Is it worth thinking about US stocks, or is that not the way you think about it? The reason I ask is we've had a Bank of America investor survey that shows a record number of investors intend to cut US stock holdings. I don't know if that's too late or if that's well-timed or whatever, but obviously we've seen a lot of pain in some places there.
Well, look, we talked about this when I was last here. The US retail own more of the US market. I think it's about 38% now, depending on how you measure it, than they ever have done. And, that's not a great starting point. Valuations are still on the rich side. I suspect that buybacks will be pared back in a period of uncertainty.
Yep.
So, the US doesn't feel like the winner in all of this because, if you join the dots, it's in principle it makes a lot of sense to try and repatriate, more production and manufacturing to the US. But you can't build a factory overnight. There isn't enough power. We've had this whole.
Yeah, it takes a lot, and that's why you're getting the flexibility in terms of what Trump's talking about at the moment.
Exactly.
The problem with all this uncertainty is that companies are just basically withdrawing guidance.
Yes, they are.
How do you? You're looking at your risk positions. You're probably tightening up. You're kind of being a bit more cautious as the market's swinging around all over the place. Introduce a lack of guidance into that kind of scenario for me. How does that change the way that you're going to approach what you do? Because if companies aren't telling you what they are expecting, how easy is it to value them? How easy is it to get the kind of visibility that you're looking for, either on the short side or the long side?
Well, I mean, the market gets there pretty quickly. When companies communicate with us and the market more broadly, they're pretty quick to withdraw guidance, and you don't see it happen very often. I mean, they might lower guidance or widen the range, which comes back to what we were talking earlier about. The volatility of earnings really matters now. So there are a whole host of companies we can look at across Europe where we've got good visibility. They've got good order books a year out, 2 years out, and again, I sort of come back to European banks because I've got valuation support. I've got good visibility of earnings. I don't think there's going to be a credit cycle in Europe.
Is it easier to do the long side than the short side at the moment? No, because in a market-neutral context, you think about everything relative to the index. So we're trying to buy stocks we think are going to outperform the index in the medium term, and we're trying to be short of stocks we think are going to underperform the index in the medium term. And I think, lots of investors make this mistake of trying to think of being short of companies that are going to go to zero. Because there are so few of them. I mean, okay, it's just an underperformance.
Yeah, I mean, look, very rarely, if you look back at, the last 15, 20 years, there are very few companies that go to zero. Now, there was three famous hedge funds, and it was myself, Lansdowne and Crispin Odey, that were very short of Northern Rock when Northern Rock went bust. But those things happen very rarely. And Wirecard is another example. It happens very rarely, but it has a lot of impact on your muscle memory. I mean, I think someone was saying to me, if you bought a Wirecard on the IPO and sold it 9 months before it failed, you made 10,000%. So being short of these stocks sounds great, but it can be, I mean, for example, I was short of Northern Rock from £5 to £11 on the way up, but we never talk about that.
No.
So managing risk, trading, and portfolio construction, correlations, sector exposure, and consensus positioning on the short side of a portfolio is much more difficult than people realise.
I'm sure. John, thank you very much indeed. Lovely to see you. Thank you very much indeed for stopping by to see us. John White, founder of Calibrate Partners. Let's take a quick look at the centre of gravity here in Europe this morning. This is what we are looking at. You've got Ferrari, ASML tracking higher, but the real story on that board this morning, as we were just mentioning, is LVMH. The stock in Europe down by 7.8%. Let's get more details as to what is happening with the luxury space. Joe's here with that.
So real widespread move in the luxury space today, Guy, really hitting a swathe of sectors within the luxury goods market. Now, Goldman Sachs calling for LVMH sales to drop 5% on the year now. Previously, before this report, they said the sales would be up 2%, so a massive drop down, and we're seeing a feed through in LVMH. Burberry, Kering, Hermes, all of those stocks feeding through after the LVMH numbers there. Then in terms of the drinks, also weak as well. Now, remember, drink sales at LVMH down 9% in the last quarter, and we can see that feeding through here into the French names Remy, Pernod, also Campari in Italy, a little bit lower, and Diageo here in London as well. Then on cosmetics, L'Oreal coming down over in Paris. Again, weakness on the cosmetics and skincare business in LVMH, and also hitting Puig brands over in Spain, the Charlotte Tilbury maker. That one hit as well, seeing losses almost 3% there. And then finally, we'll do a fourth board on the LVMH read across, because the watches and jewellery makers also hit. Richemont coming down, Swatch also, and Watches of Switzerland, the Rolex dealer listed in London, all of those coming down pretty significantly following that report. So really the big feed-through of the morning coming from that LVMH report. Then going the other way, a bit more green over in autos. We're seeing Stellantis pretty much mirroring that gain that we saw in the US stock. Trump indicating potentially some reprieve, some respite on the auto tariffs. So that is feeding through into that sector today. The German companies also coming up as well. Mercedes, BMW and parts, Michelin, a little bit higher over in Paris as well. Then on terms of the telecoms, we've got Ericsson. Pretty good numbers out of that one, and they are up 7% over in Stockholm. The company actually finally seeing a bit of a better outlook in their supply of 5G equipment, so that is boosting Ericsson today. And I think Nokia was ticking a little bit higher as well, so doing well on that. A positive report from Ericsson this morning. And then finally on BE Semi, Applied Materials taking a 9% stake, and the market liking that a lot. That is one of the biggest chip machinery companies in Europe, and they've already got a partnership, the two firms, so that is more positivity for that one. Bit more positivity on semis. That one gaining 8% or almost 9% over in Amsterdam, making up for a bit of the weakness in luxury goods this morning.
Joe, thank you very much. Joe Easton from our equities team. Coming up, we will go back to one of the stories Joe was talking about there. LVMH leads Europe's luxury stocks into the red after disappointing sales results. We will take a deep dive into the sector next. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Welcome back. We are 18 18.5 minutes into the trading session. European equities are broadly higher. The CAC 40 is lower. We can blame the luxury space for that. In terms of the bond market, generally a bid coming through, except in US Treasuries, where actually the market's on offer this morning. But let's come back to what we're talking about with equities and figure out what is happening with both cars and luxury. Going to start with the luxury side of the equation right now. Andrea Felstead joining us now. She's here to talk about LVMH. You cover luxury for Bloomberg Opinion. What's the opinion of these results? What do we learn from these numbers from LVMH?
We didn't learn very much, actually. The big swing, the reason they underperformed worse than expected, was because this time last year, lots of Chinese were travelling to Japan to buy luxury goods to take advantage of the weak yen. That's still going on, but not as spectacular as it was a year ago. In the US, which everyone wanted to know about, demand for fashion and leather goods and watches and jewellery is holding up, which is encouraging. Now, where they could be seeing some tariff impact, but it is a could, is Sephora, the beauty retailer, which appeals to the more aspirational shopper. But again, that had very strong performance a year ago. Now, the one that probably is seeing some impact is wines and spirits, because again, that appeals to a much broader customer base, i.e. think the less wealthy. So far it hasn't shown up in handbags, but it might have shown up a bit in makeup, and it probably has definitely shown up a bit in drinks.
That's interesting, isn't it? Because you think of Sephora and you think slightly, lower priced compared to the other things that LVMH says, and in times when they're tough, you think maybe people go to buy the slightly cheaper end of the spectrum. But anyway, what about pricing then, Andrea? What did we learn about pricing? There was this line about possibly putting up some prices as a result of tariffs.
Exactly. I mean, they will have to pass on some impact from tariffs. They've got away lightly compared with the mass market and the apparel makers. It would have been much easier to put up prices 5 years ago, because all the luxury brands, including LVMH, have pushed up prices a lot over the last 5 years. One of the issues they're facing is this luxury fatigue, where, there's big reflation in luxury goods and consumers are noticing it. That makes it much harder to put up prices this time round.
Where would they put up prices, though? If we get to that point where inflation is a bigger deal and we need to have some of that kind of margin pressure eliminated, where would be the first goods that see that?
I would think it would be fashion and leather goods. They are the ones that are, theoretically most in demand. They were talking about not really putting prices up, but getting consumers to elevate through the range, so i.e. getting them to buy more expensive products. And that's probably a bit tricky, because a more pressured consumer wants cheaper goods. It's one of the reasons why we have lots of brands that are slightly cheaper at the moment. Coach, for example, is flying because its bags are still pretty nice. They compare well with the European brands, but they're much, much cheaper.
So is that not good news for Hermes when it reports numbers Thursday?
Hermes will be a completely different story.
I did wonder about that. What about Sephora and L'Oreal, though? Is there a read across there?
I think that there is definitely a read across. Yeah, I mean, the other thing to remember with cosmetics is it's been an absolute boom for the last 5 years. It's been lipstick, it's been skin. Hair's been a massive category of growth. How many, lipsticks, how many fancy hairstyling products do you really need?
You're looking at the wrong person.
Yeah, guys. When times are tough,
Guy needs many.
You just think, well, I won't spend £20 on that. Heat protector, I'll spend, £5. So, there's been this cyclical boom that is probably due for a correction.
I think heat protectors, I think boilers, I think like that. It's a completely different ballgame.
Guy's life must be very nice not to need a heat protector. I definitely need it. Andrea Felstead from Bloomberg Opinion, we thank you so much. Let's continue on where maybe some of the other pain that we're seeing this morning may show up or not show up. European automakers in the green this morning after President Donald Trump said he was exploring possible temporary exemptions to his tariffs on imported vehicles and parts.
I'm looking at something to help some of the car companies where they're switching to parts that were made in Canada, Mexico, and other places, and they need a little bit of time because they're going to make them here, but they need a little bit of time. So I'm talking about things like that.
For more, let's bring in Craig Trudell, who heads up our Bloomberg's global automotive coverage. Craig, should we be happy about this temporary reprieve?
Everything's all good now, right? Yeah.
Is it?
I think the answer to that is no. I think, how exactly is this going to work? How short is short term are we talking here? it's going to take these companies and their supply chain, at least a year, maybe 2 years, maybe 3 years, to do the level of reshoring or onshoring into the U.S. that Trump, I assume, would want here. Is he going to be willing to cut, sort of that long a slack for this industry? He's a fairly impatient individual, and also, I think in terms of what is actually happening on the ground, I'm not sure we can necessarily take him at his word that the companies are ready to do this, given the way that he's talked about, what some of these companies have been up to, and how much what he says it doesn't necessarily measure up with what they're actually doing.
What's happening in the U.S. car sector at the moment? What's going on? Is anything going on? What are these guys doing? Are they? How quickly can they turn things around? Where is inventory building up? Where is there shortage? Just give us a quick kind of thumbnail of the effect that we are seeing thus far to make Trump react like this.
I think we are seeing the shares of these companies being hit, much as we're seeing this relief rally just yesterday on the slightest sort of nod to the idea that maybe they'll get some short-term relief. They are getting hurt. I think perversely we are seeing a lot of buyer activity, a lot of people going to showrooms to try and get a vehicle before prices go up, because we haven't necessarily seen an immediate move here. We are seeing, some car makers actually, holding vehicles at ports until the tariff, situation clears. We will see prices go up of imported cars, but we do have the situation where we're still a couple weeks out from the parts, tariffs hitting, and so we're not necessarily feeling the full brunt of what Trump has talked about to this point.
That's interesting. And to your point about what the companies are saying they're doing, how much reshoring are they really talking about doing here?
They're being pretty mums of word. I think they are, what we've been hearing out of Detroit is that they've been trying to kind of put emphasis on, let's go easier on the North American supply chain, at least that's closer to the U.S. For a long time, these were our allies. And we understand, the low-cost imports from outside of the region. But, let's at least consider the sort of strategic value of part supply being close to us, at least on the continent. I don't think from that answer that we just heard from the president that he's actually viewing Canadian and Mexican parts content as a positive. He wants it all for the U.S.
Yes, it seems like the business leaders are maybe thinking about supply chain risks, whereas President Trump is thinking about something more political. Thank you very much for bringing us that. Craig Trudell, of course, who leads Bloomberg's global automotive coverage. And so those few words from President Trump: Stellantis up 3.9%, Valeo up 3.6%, and the addiction to lines coming out of the White House continues. Coming up, Treasury Secretary Scott Bessent rejects speculation other nations have been dumping U.S. bonds. We hear from the CIO of Andromeda Capital Management on the ongoing volatility amid the trade war. Things a little bit calmer today, perhaps. Feels dangerous to even say that. U.S. futures pointing a little higher now. This is Bloomberg.
You missed it on Balance of Power.
The statute governing the FTC says commissioners can only be removed for cause. Was there any indication that you were fired for cause?
No, there was no claim of cause, and the statute actually specifically says cause means neglect, malfeasance, or inefficiency, and there was no claim of any of those.
So as we talk about some of those other examples, keeping in mind we are having this discussion with you on the day we got a Fed rate decision, is this directly applicable to what is supposed to be an independent central bank? Is that one way in which market participants should be looking at this?
Yes, that's exactly right, and market participants should be scared. To be clear, there's no legal difference between Jerome Powell and me. In fact, he and I were both originally appointed by President Trump, and if the president can illegally remove me, he can illegally remove Jerome Powell. People should be very worried about that.
Don't miss Balance of Power live every weekday.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern, only on Bloomberg. Context changes everything.
Welcome back. This is the opening trade, 30 minutes into this morning's session, and this is the picture that we have now for European equity markets, up by more than 1% on the DAX, and that seems to be leading the way. So the autos lines, even though they were few and far between from President Trump, they certainly have reignited interest in that sector this morning, and we see some of those names go higher, as we discussed with Craig Trudell in the last part of the program. That's the upside. The downside is the CAC 40. There we are down by 0.4%. LVMH is the big driver, disappointment on the US and China, and that weighs on the wider sector. Now, a record number of global investors are planning to cut their holdings, though, of US stocks. That is according to Bank of America's latest global fund managers survey. Let's bring in Bloomberg's Valerie Teitel, who has more on this, Val.
Anna, this survey really pointing to the fact that investors are shying away from U.S. assets. As you mentioned, there was a record number of investors saying they intend to cut their U.S. equity holdings, and this comes alongside an already largest ever 2-month drop in U.S. equity allocation since the beginning of the survey. You pair this with the fact that they also saw around 80% of respondents saying that U.S. exceptionalism has peaked and they're looking to take their investments elsewhere. Plus, a 30-year high. 82% expect the global economy to weaken in the year ahead. Now, I want to contrast this quite bearish report with what's going on in the market at the moment. Yes, the S&P is down on the year, but we are only less than 3% down from Trump's tariff announcement on April 2nd. Doesn't necessarily paint such a grim picture as that fund manager survey. And also take a look at what's going on in credit spreads, Anna. We have seen quite a collapse, quite a narrowing of credit spreads since they blew out last week on both sides of the Atlantic. Credit spreads here in Europe, credit spreads also in the U.S. We've also seen a return to market functioning. We've seen a return of high-yield issuers coming back to the market. This is not necessarily painting such a grim picture on the economic outlook as perhaps that was reflected in that fund manager survey.
Great stuff, Valerie. Thank you very much indeed. Let's carry on talking about what's happening in the credit space. Alberto Gallo, CIO and co-founder of Andromeda Capital Management, joining us around the table. Credit's tightening up again. Market's beginning to function again. We're seeing issuance again. Panic over? Like, what do you? How do you see what you see in front of you right now? Is it glass half full, glass half empty?
I think there's two tail risks in the world today. One is a tail risk of recession.
Yeah.
A lot of investors are worried about today. And the other one is a tail risk of persistent inflation and interest rates not paying enough to compensate for that. So debt monetization by governments. So if you think about what's been happening, we see it as a geopolitical stress test. The U.S. has pushed to its limit its allies. It's trying to gather more allies under its banner. It's trying to isolate China and redraft the terms of trade.
Yep.
And you could say that in some ways this stress test has failed. We've gone to the limit of volatility in markets, and potentially we're going to skirt a 0-point low digits growth number for a quarter or two. So this has been done, but we don't have a recession. What I'm really worried about is that central banks will have to monetize larger deficits. You've seen the tax proposals. You've seen that even with DOGE, even with potential spending cuts, the U.S. keeps spending. So this is a public debt problem. It's not a problem in corporate balance sheets or household balance sheets.
So we do, basically, the debt has become too big, almost independent of what happens in the growth numbers. This is a buyer and seller story now. It's are there enough buyers? There's clearly a big seller of debt, but are there enough buyers? And your belief now is that ultimately governments are going to have to buy it, central banks are going to have to buy that and step in where others won't.
Diamonds are forever, monetary systems are not, right? If you look at the history of monetary systems, at some point, governments tend to spend too much. Something goes wrong with growth and productivity, and they resort to essentially issuing currency or printing money. And that's essentially what's happening in the West. We see the Fed, the Bank of England, and the ECB, cutting rates and potentially keeping rates well below inflation. So duration and generally government debt is something we don't like. Where are governments spending? If you look at Germany's stimulus, the EU stimulus, they're spending in infrastructure and defense. They're going to support the private sector. So credit is actually not a bad place to be, and it's a better place to be in areas where governments can spend more. So Germany has been very tight on fiscal spending for the last 20 years. Right. They're now open their wallet, and this is going to benefit growth across Europe. Italy got upgraded last week. Yeah. Who would have said in this environment? Everyone was worried about issuance, but actually spending is good for growth if you were doing austerity for the last 20 years. So European credit has currently the largest short positioning in the credit default swap market of the last 15 years. Essentially, all-time short positioning by investors and allocators. And typically, investors are very underweight European assets. So if you are worried about debt monetization in countries where there's high inflation, high deficit, you probably want to go in the ones which have been more conservative. So investors we see are, looking for more European assets. And, you want also more real assets. You want things that defend you from this persistent spending. So I'm a lot more worried about risks to the monetary system, what Scott Bessent didn't want to talk about yesterday, which is, the Mar-a-Lago Accord, than 1 quarter of growth at 0.5%. That doesn't worry me. Corporates are in good health. Yep. There's no refinancing wall. They've all termed out their debt, and leverage is very stable, especially in Europe.
Is there a question, though, of too much issuance? I mean, we keep hearing about this when it comes to just how orderly the markets are and that people are able to digest it. But for how long, if the deficits do remain kind of lurking in the background?
The long end of the yield curve is definitely the problem. And you know why we'd never really had a default cycle in the U.S. when the Fed was hiking 500 basis points is the curve was inverted. Yeah. So large firms like Google or Apple essentially were able to run a carry trade. They were already funding at long-end rates, and then they were investing in T-bills. And similarly for households, 99% of households has a fixed-rate mortgage in the U.S. So central banks and treasury officials in the world are definitely worried about the long end, going steeper and wider. But what does that mean? Well, it means that if the long end keeps going higher, there will be countermeasures. And one of them is potentially reducing quantitative tightening. The Bank of England has already paused. Another one could be lowering maturities, and eventually we'll go into a yield curve control environment where essentially currencies will take the hit. Governments today, in a very tense geopolitical environment, cannot afford big spikes in unemployment. And the real risk in my mind is that there's a de facto recalibration of the inflation target by central banks. We've been 48 months above target. Something is transitory and it's not. So, if we keep going above target, and this year we will, then, you're de facto changing your inflation target.
But so lots of things they can do to step that in. But what's the tell on that? If you are talking about yield curve control, if you're talking about the Federal Reserve coming to the rescue, or the Treasury for that matter, Scott Bessent, for example, talking about that, what's the tell? What's the red flag? What's the canary in the coal mine?
I think the sustainability of the dollar as a reserve currency is slowly put under question. And in part, this has been also a geopolitical strategy from China to promote the yuan. But we see also investors, being worried about real returns. So we see gold at record highs. We see demand for stocks, for credit, for real estate. And, I was in a meeting with central banks a few weeks ago, and the question from the central bank was, why are investors so bullish on everything? My answer was, investors are not bullish on everything. They're bearish on central banks. They're bearish on fiat currencies.
Yeah.
So I'm not too worried about the volatility today.
Yep.
I think that's an opportunity to buy solid assets. But I think investors need to rethink the way they structure their portfolios and the way they think about allocation and correlations. For example, think about a balanced portfolio today or a risk parity strategy today when the safe haven asset is no longer behaving as a safe haven asset.
Alberto, thinking about that then, and you mentioned that the final aim here you think is to isolate China, and that geopolitical strategy then is playing out and being acted upon at a time when the United States is, well, should it be more worried about who's going to come and buy its treasuries, to Guy's question? So if you upset China and they don't want to buy so many treasuries, how does this end?
I think that in the near term, this will end into a negotiation, but there are some long-term consequences that will stay, and one of them is probably investors questioning the amount of trust that they have to put into U.S. assets. So, we used to think that currencies traded in terms of interest rate differentials. They're now trading in terms of trust differentials. I doubt that the U.S. will be able to reconstruct a manufacturing base that is as strong as it used to be 20, 30 years ago, simply because China is now very far ahead in the game. So this line in the sand that the U.S. is trying to trace against China will work as a stabilizer, but will not stop China. And in some cases, if we look at the manufacturing challenge, China has already won.
Yeah. So if the end goal was to isolate China, why upset everybody else along the way?
I think this is a way, if you think about, Athens and the Delian League in Greece, it's a way to sort of force allies to gather together with the United States and tell them, you're either with us or against us. And the execution probably, I think the end game is understandable. The execution probably has been a little bit too volatile and could have been potentially done better, like every other portfolio manager has said, but this is about the middle and lower income class, right? Not about financial markets. But in doing so, obviously there is some damage to the U.S. brand and to the ability of for investors to keep the long end, to keep duration in U.S. assets. So that's something that has reached a little bit a test.
Yeah. What do you own in a world that is trying to monetize debt? What does history teach us about what you want to own? Like, is it agricultural products? Is it what do I want to own in this kind of environment? If that's where we're heading for, monetization of these huge debt piles.
So essentially, you have to think about the paradigm of financial markets in a different way. Like the safe haven asset is no longer a safe haven. So you don't want to have something that is a balanced portfolio or a risk parity. It's not something that is based on.
What do I want to own?
What do you want to own is real assets. So you want to own gold. You want to own something that has a link to cash flows that grow with inflation. You want to invest alongside with governments. So, for example, think about Europe. They're doing infrastructure. They're doing defense. And these are sectors where governments in Europe had underinvested for decades. So there's a lot of upside there. You want to own private balance sheets, so corporates and households, so credit instead of governments. Governments are spending to help the private sector. There's a lot of high-yield names in Europe that got government help, from banks, telecoms, to airlines. So you want to own those names that give you between 7 and low teens coupons, instead of owning government debt at 3-4%. So you're getting paid for it.
Yeah.
And you want to own assets in more stable jurisdictions that have room to spend and where inflation is still low, so essentially Europe, rather than the US, which is very overweight. One silver lining around the UK obviously lost a bit of ground with Brexit and all that volatility, but there's signs that maybe as a silver lining that, it will get a little bit closer to Europe after the Brexit fallout. Not reversing, but a little bit closer. So I think that there is a lot of upside in Europe, and positioning is completely the other way right now.
All right. Alberto Gallo, CIO and co-founder of Andromeda Capital Management, talking to us a little bit about what you should own in this very volatile environment. Guy was talking about perhaps the Birkin bag being the answer to that question. Really funny that he makes that reference, because as we were speaking to Alberto, we also got headlines across that Hermes has surpassed LVMH as the world's most valuable luxury company. This, of course, coming after the massive hit you saw in those earnings as well. LVMH shares down a whopping 8%, Anna. So maybe Guy had the right idea around the Birkins.
Always come to me for handbag
fashion,
advice.
Yes,
and skincare.
This I know on the 15th of April. Coming up on this programme, big banks in focus then. We recap JP Morgan and Goldman's earnings and look ahead to Bank of America and Citigroup's results later today. We've heard a lot about trading. We've heard a little bit about M&A. We've heard a bit about bank regulation. Will we hear more about the US economy and the consumer? That could be interesting. That's next. This is Bloomberg.
First time, got to many times go visit with Steve Jobs to try to get an Apple box to be our box. And we were trying to merge boxes. And of course, they have Apple TV, and we have our box. Never actually happened. And in one of the meetings, he said, well, you should give up because we're going to win that. But you should put Wi-Fi in all your boxes. And that's how you'll win. And you should be the best pipe. And he said the best dumb pipe. So I went home, went to our chief technology officer and said, what's Wi-Fi? And today we have the nation's biggest Wi-Fi network. And we have more customers. And 90% of your cell phone usage, 90% is Wi-Fi. Right. And that's because 70% of all the bits going over the internet right now are streaming. And streaming wasn't here 10 years ago. So I sit here and say the most exciting thing about our company is what's coming in the next 10 years that happens in innovation around the world, hopefully here in America, hopefully Silicon Valley, and LA and everywhere else, Philadelphia, and that we're going to continue to have bits per home go up.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
I think there will be advantage to our allies, especially, and a first mover advantage. Usually the first person who makes the deal gets the best deal. So
who do you think will be first?
It's their choice. I think there could be numerous countries that are going to move with all deliberate speed. And again, it's going to be a process. The tariffs are the easiest part. So a country with high tariffs, you can just say, okay, this, get rid of it. It's the non-tariff trade barriers that are more insidious, more difficult to spot. And it's probably going to take a little longer to exercise those demons.
Insidious demons. Interesting language around some of the non-tariff trade barriers. The US clearly doesn't like them. Scott Bessent clearly doesn't like them. Speaking to AMH there, down in Buenos Aires. Let's talk about how the EU is viewing all of this. The EU Trade Commissioner Maros Sefcovic says the bloc is ready for a fair deal with the United States. This after he had a meeting with the Commerce Secretary, Howard Lutnick. Spain also signalling a pivot towards China, which is worth paying attention to. Certainly Washington is. Let's figure this all out and pull it together. Ollie Crook joins us now. Ollie, what have we learned from Sefcovic's trip? How far away could the EU be from a deal? The language before we started to see Trump imposing tariffs was quite hostile towards the European Union.
Yeah, repeatedly, whenever you get a press conference, you sort of get some new insult at the European Union, what it was sort of there designed to do, and whether or not you ever see a Chevrolet on the streets of Munich. That is what we heard from the president yesterday. What we hear from Maros Sefcovic, he's going to brief diplomats today about the 4 hours of discussions he had with Jameson Greer and Howard Lutnick. He put out this tweet yesterday, and I'll just sort of go through this to kind of to take you through what they talked about, that the EU remains constructive and ready for a fair deal, including reciprocity through our 0 for 0 tariff offer on industrial goods and the work on non-tariff barriers. Now, the 0 for 0 idea is basically to put a free trade zone between the EU and the United States on industrial goods, 0 tariffs for 0 tariffs. That isn't so far off of what we had before the new tariff regime from the Trump administration. There's about half of a percentage point on average between the difference in tariffs between the EU and the United States. So the United States is obviously going to want more. That takes us to this concept of exercising these so-called demons of non-tariff barriers, where things get a little bit more complicated. The U.S. has, for its part, has not yet defined what all of these non-tariff barriers are. If you listen to Peter Navarro, who reiterated this over the weekend, that those could include value-added tax. You talk to any policymakers here in Europe, they say this is basically a sales tax. It is applied indiscriminately to things that we produce in Europe and things that we import. That's basically off the table. I talked to the German finance minister, though, and he said something that where maybe you could have some agreement is getting universal standards on auto manufacturing and regulation, so that basically a car that's produced in the United States could be sold in Europe without any sort of amendments due to sort of regulatory concerns and any differences you'd have in the EU. That being said, Guy, one of the very challenging lines here for the Europeans is basically wanting to give the U.S. concessions on these ideas of non-tariff barriers, while at the same time not basically being legislated on domestic law from the White House.
Yeah, certainly an evolving conversation we'll continue to watch then, Ollie. Tell us a little bit about how Spain is playing this, because I know that we've got Giorgia Meloni going to the United States. You've told us about what Maros Sefcovic has been up to on the trade front. But we also have the Spanish leader heading to China. He's been in China, and he's been in Asia, and he's been talking about closer ties there for some time. What's the latest?
Yeah, and I think as sort of attractive as sort of a narrative this is, the idea that basically the Europeans would move away from the United States and towards China in the face of what has been fairly erratic behavior out of the Trump administration is frankly a fairly negative, limited appetite within Europe. You do have the Spanish that are basically saying they want stronger diplomatic, stronger economic ties with China, but that is something that is not gaining traction really across the European Union. What is interesting, I think, is basically a difference that seems to be emerging within the White House itself, where you have Scott Bessent, who seems to be wanting to get people on side, the allies of the United States, to strike quick trade deals to get that sort of issue resolved so that they can potentially collectively have a trade approach towards China. And for the Europeans, that's kind of pushing against an open door. The Europeans are very alive to the threat that industrial policy in China poses to the EU, so potentially would be open for that sort of thing. That being said, the Treasury is not setting tariff policy. It's Donald Trump. And there are a lot of the people who are on board with Donald Trump's goals in terms of balancing global trade and on China, but basically not endorsing the method, which has basically so far been waging collective tariff war, which would make it potentially a lot harder to get people on side within China. But let's see how this policy develops, because again, the Europeans would potentially be on board to get on board with the United States in terms of a collective approach on China. Remember, before Trump was elected president of the United States, the biggest threat to the European economy, as the Commission saw it, was China.
Well, let's see if that consensus maybe changes or warms as we get closer to that July visit. Bloomberg's Oliver Crook, we thank you so much for giving us that crucial context as we, of course, navigate all the geopolitics that Ollie was laying out there. Plenty of data, plenty of kind of data points to be keeping an eye on, especially in the next 24 hours. At 9 a.m. UK time, in just about 8 minutes, we do get the ECB bank lending survey. About an hour later, the Germany ZEW survey, ZEW, if you're feeling fancy. And then at 1:30 p.m. UK time, the U.S. Empire Manufacturing Survey. So it's basically New York is going to show some of those economic data crunches you're seeing in other parts of the country. 1:30 p.m. UK time, Canadian CPI. But I think the highlight for the markets come back to some of those bank earnings. Citigroup, Bank of America, a little bit United.
United Airlines out. Scott Kirby's going to be out with his numbers a little bit later on. Does he do an Ed Bastian and effectively withdraw guidance? He has a much bigger exposure globally. Be interesting to see what he has to say a little bit later on. But the banks certainly are a big focus later as well. Bank of America, Citigroup's earnings come after Goldman Sachs stock traders posted their highest quarterly revenue haul on record yesterday. This was David Solomon speaking on the earnings call, and there's a certain amount of optimism about trade policy coming from Mr. Solomon.
This uncertainty around the path forward and fears over the potentially escalating effects of a trade war have created material risks to the U.S. and global economy. We are encouraged by the administration's recent actions to pursue a more gradual policy process that allows for considered negotiations with many countries. But how policies will evolve is still unknown.
David Solomon. A lot of optimism coming through from him. Charlie Wells is sitting next to me to carry on the conversation. He sounded pretty positive on the economy, but he also he listed a whole lot of things that he kind of hopes are going to happen.
Yeah, Guy, you know what? He also didn't list at all the word tariff.
Yeah.
That was not mentioned on the call
Like deregulation, all that kind of stuff.
Yes.
That's all coming.
Kind of trying to return to that kind of November talking point playbook of, yes, you know, we're going to get all the candy and none of the vegetables.
November was lovely.
Exactly. We're going to have the deregulation on the capital front, on the leverage front, on the supervisory front. So really trying to seem to sort of shift the narrative and take it to the extreme. But you know what? They had a good quarter, right? Yeah. Their equities trading did quite well there. It seemed like he was hoping that administration officials were listening to that call, kind of saying, we hope that those who are making policy will listen to businesses large and small.
So where does that leave us then in terms of the bank earnings story? Because we've heard from Goldman, we've heard from a few of them. How are analysts expecting that Citi and Bank of America will fare? The story up to this point has been around trading, or the strength certainly has been around trading in equities.
Right, so we're kind of rounding out big bank earnings season. And I think something interesting is, you know, how are these two banks going to navigate this trade war? And how are they going to communicate? Are they going to follow the strategy that all these executives have been following, which has been, you know, admit to some of the difficulties, but really focus on the positives? And I think, you know, there are some difficulties for these two final banks, right? Citi is really interesting because so much of their net revenue comes from abroad. I think it's about 50%, which is pretty striking there, bigger than the rest of the big banks in the U.S. Also credit cards, right? So they have a high proportion of their loans coming from credit cards. If we get to a downturn situation, that could be bad because we know loans for credit cards are very volatile in downturns. Thinking of Bank of America later today, net interest income. That's something we haven't been hearing too much about this earnings season, but that could be under pressure if we get to this rate environment.
You're speaking Critty's language here. She's been deeply interested in the fate of credit cards and autos loans.
Well, in autos loans, this is true, but in the FX piece, right? You mentioned that the majority of Citi's revenue comes from abroad. This is why you can have international credit cards with Citi that you can't, or it's harder to have with some of the other banks as well. So the FX cost, especially with the dollar weakness, is going to be a really crucial one as well. Very quickly, Brian Moynihan, has he said anything? He was kind of the consumer bull.
He has been the consumer bull, and Bank of America has a lot of consumer exposure, right, across mortgages, of course, across credit cards as well. He's going to want to dance very delicately today because remember earlier this year, he was called out point blank at a very public event. So I think he's going to have to kind of really kind of thread the needle carefully there.
Especially as we kind of see Jamie Dimon and David Solomon with the same message, doing a little bit of a U-turn. Bloomberg's Charlie Wells walking us through those bank stories. Of course, he'll be back later throughout the week giving us those updates as well. Later today, we are going to speak with a Hyundai CEO on how South Korea's largest automaker will try and navigate Donald Trump's tariffs. That conversation coming in at 3:30 p.m. UK time as the Trump administration remains very optimistic around trade deals with Japan and South Korea. In the meantime, a mixed picture for stocks. That does it for the opening trade. The Pulse is up next. This is Bloomberg.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
A deal is going to be made with China. Nothing's over yet.
There's been a lot of confusion up to now.
A 90-day pause is not an eradication.
Where is this leading to?
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Auto shares drive gains in Europe after President Trump floats a potential auto tariff pause, but reiterates new levies on pharmaceuticals and semiconductors are coming. U.S. Treasury Secretary Scott Bessent rejects speculation that foreign governments are dumping U.S. debt. We'll bring you more from our exclusive interview. And LVMH shares sink after the luxury giant posts a sales slump on weak consumer demand in China and the United States. The group warning it's considering price hikes to offset some impact of tariffs. Let's have a quick look at some of the assets and how they're trading this morning. Good morning to you. This is the picture on US futures, I should say. They do point a little bit higher. We're up 0.2%, off earlier highs. NASDAQ futures up 0.4%. We've also got euro dollar in there for you as well. 113.55, moving towards a ECB rate decision, of course, later on this week. A slight sense of calmness, though, around markets and some interesting stock market moves. So let's get to those. Let's bring up the European markets map and show you where we are across various geographies. We are underperforming in Paris and outperforming in Germany, and that tells you a lot about the sector breakdown of what we're seeing here. So luxury names are going lower, autos and auto parts manufacturers are going higher, and as a result, that's the breakdown. That's what we see across these European equity markets today. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Anna Edwards, in for Francine Lacqua this morning here in London. Let's start with a breaking news story. China is said to have ordered its airlines not to take any further deliveries of Boeing jets. It's the latest development in the tit-for-tat trade war between the world's two largest economies. Bloomberg's aviation reporter Danny Lee joins us now. And Danny, this story just breaking right now. What do we know?
Yeah, Anna, good morning. What we are seeing is a broader cachet of companies being caught up in US President Donald Trump's trade war, in which at least Chinese goods, they're being imposed a tariff of up to 145%. Now, what we know this time is that the Chinese government has asked its carriers to stop taking delivery of Boeing aircraft in the meantime, and this extends to aircraft-related equipment and parts from US companies. Now, this order came last week, just as China retaliated on the US with tariffs of 125%. And for the airlines, it makes the economics of buying an aircraft more challenging. It doubles the cost, frankly. And we have heard these warnings from a number of airlines globally, from Delta to Ryanair recently, about the warnings of aircraft deliveries being delayed. But in this case, for China, given this rapidly evolving trade war dispute, we don't know yet if any of these positions would change in the next week or two or longer. We have seen, for example, Donald Trump's position on Apple iPhones, for example, change.
Yes, indeed. Some of these positions have been stuck to by the Trump administration, and some have appeared more flexible, or he has appeared more flexible in how they are applied. So how significant is this then, Danny? I mean, what role, how significant for Boeing? How significant for Chinese aviation? What role do the two play with each other?
Well, it is extraordinary that two of the world's largest economies are facing off, and frankly, that Boeing once again caught in the middle of all of this. And for Boeing, China used to be one of its most important foreign markets as far as the billions of dollars worth of commercial aircraft it could sell into the country. And of late, over the last several years, it's been enormously difficult, and Boeing hasn't won a large aircraft order from a Chinese carrier for many years now. And it comes against the backdrop, frankly, of China trying to develop its own commercial aviation plane-making capabilities. And so it's increasingly being squeezed out in the Chinese market. And when you look at the growth prospects over the next 20 years, the fact that China is going to account for a fifth of all aircraft demand, it does remain to be seen what role Boeing has to play in the years to come. But clearly on something like this, with Chinese airlines being asked to stop taking delivery of Boeing aircraft, Boeing, it said, had declined to comment on this story.
Okay, and as we see, the pre-market share price of the pre-market of Boeing is we're seeing this story having impact there. The stock down by 3.7% as a result of this news flow. Thank you very much, Danny. Bloomberg's aviation reporter Danny Lee joining us there. On to another sector that is very much caught up in the tariff story. Auto shares in Europe are higher this morning. That's after President Donald Trump said he is exploring possible temporary exemptions to his tariffs on imported vehicles and parts.
I'm looking at something to help some of the car companies where they're switching to parts that were made in Canada, Mexico, and other places, and they need a little bit of time because they're going to make them here, but they need a little bit of time. So I'm talking about things like that.
For more on the auto sector and the wider trade narrative, let's bring in Craig Trudell, who heads Bloomberg's auto coverage, and Brendan Murray, who's a global trade czar here at Bloomberg. Craig, let me come to you first. Is that it? Is the auto sector out of the woods? I mean, he's talking about them just needing a little bit more time, a temporary reprieve. There's a lot we still don't know here.
Yeah, we don't know. When he said some car companies, we don't know which car companies he's looking at potentially lending a helping hand to. We don't know for how long this reprieve would be, as you mentioned. And this is an industry that does not move in sort of weeks or months. This would take years to uproot where they're making things now and move it to the U.S. I think it's also pretty remarkable in the brief comments that we heard from the president yesterday that he's not necessarily talking about moving parts production or supply base from outside of North America. He wants it from the U.S.'s neighbors in Mexico and Canada, which would be a pretty substantial change for the industry and something that I think the industry is very reluctant to do because it has operated for decades now as sort of viewing particularly Canada as sort of one and the same in terms of parts content.
Yeah, the broader picture, Brendan, this morning on tariffs seems to be that the president is giving with one hand to the auto sector, saying there might be a temporary reprieve, as Craig has described, but then taking away with the other, reiterating that pharmaceuticals and semiconductor chip electronics, those are going to be captured by some kind of sectoral tariff in the near future, and there's a probe going on into that. What are we learning about the way that tariffs are being applied by the US administration? Because there does seem to be a bit more change, a bit more flexibility.
Yeah, exactly. So it was almost 2 weeks ago when you remember we had Tariff Liberation Day. There was the big Rose Garden ceremony, a giant tariff wall around the United States economy. And I think what we're finding is the reality of trade wars is that you need doors in that wall. Otherwise, you collapse industries like the auto industry. So what's happening is the president is finding out that in order to carry out the policy that he wants, and that to bring auto jobs back to the U.S., he's going to have to take his time with it, and it can't happen overnight, as Craig said. These are going to take these 232 investigations on autos and chips and pharmaceuticals. They're going to take months and months, and there's going to be a lot of back and forth with the industry to say, with them saying, look, we're going to need some exclusions, we're going to need some more time. So I think you will see more and more of this, more, as you say, flexibility, but it's a realization that these things will take some time.
Yeah, so much for the so-called reciprocal tariffs providing us with clarity, because we seem to still see a lot of oscillation around that starting theme, if you like. Craig, what about the impact on American consumption of cars then? I mean, are we going to see American consumers able to swallow higher prices when it comes to autos? Is that the part of the supply chain that's going to be hit? Is it going to be consumers who have to pay up?
I think that's a big question how disruptive is this going to be when the consumer is already very stretched? We saw in the first quarter that the U.S. set a record for the share of new vehicle loans that were 84 months or longer. So we're talking about 7-year-long auto loans. Already also seeing, ticking up in things like repossessions and consumers falling behind on their payments. So we already have an industry where the average new vehicle is approaching $50,000, and we're talking about layering on top of that, thousands of dollars in additional costs in the form of tariffs.
Yeah.
So a real question about whether or not this is going to unintentionally lead to some shrinkage of the U.S. auto market.
And Brendan, what do we watch for from here? There's the sectoral tariffs then still to come, these various probes by the Commerce Department. We'll watch for the results of those and where they take us. What else in tariff land are we watching for?
You've got two basic tracks. You have governments trying to negotiate the reciprocal tariffs down over the next 90 days, and then you have industries, the chips, the pharmaceuticals, and the autos, steel and aluminum, trying to figure out a way to help the administration accomplish what it wants to accomplish without crashing the economy. This Boeing development too that you started off with is it'll be really interesting to watch how the White House responds to that.
That's a significant one. Thank you very much to both of you. Thanks to Brendan Murray. Thanks to Craig Trudell. Now, the U.S. Treasury Secretary Scott Bessent has played down the recent sell-off in the bond market, rejecting speculation that foreign nations are dumping their holdings of U.S. Treasuries. In our exclusive interview, Bessent also flagged his department has the tools to address any dislocation if it's needed.
I don't think there's a dumping, and I think we saw in the tick data either today or Friday that actually foreign ownerships picked up.
So you don't think it's sovereigns, potentially it's hedge funds unwinding?
I have no evidence that it's sovereign.
That's the view then on the Treasury market and what caused that spike up in 30-year yields, perhaps then leaning more towards hedge funds rather than what we see from sovereign holders of Treasuries, notably Japan and China. Let's have a look at where the dollar is right now, because we also heard from Scott Bessent in that interview, him saying that they still have, as an administration, a strong dollar policy. Well, the dollar has not responded very strongly to what we've seen coming out of the White House now. He cast his mind back, of course, to the first Trump administration and was talking about what tax cuts and other measures delivered later on in the first Trump administration. So we'll see if there are any parallels there. Let's talk FX then. Jeremy Stretch, head of G10 FX strategy at CIBC, joins us here on set. Jeremy, nice to have you with us. Let's start with the dollar then, and the role that the dollar plays in the global economy. You can't move for conversations about whether the dollar is still the reserve currency. I wonder your view on that, and whether it matters if there is not one clear alternative, or whether we end up breaking things up and we don't have to have one key reserve currency. What's your thinking?
Well, of course, the US has relied on that exorbitant privilege over the course of the last 40 or 50 years to really drive investment flows into the US Treasury market. Now it seems to be the case that obviously there are investors now starting to question whether that sort of mentality and that certainty about the dollar dynamic is going to prevail and whether there is going to be a more liquid alternative. Now, of course, I've been around long enough to remember pre-Euro days and how that was debated as that was going to be the currency of choice that was going to really challenge the dollar. And indeed, it started to do that until the global financial crisis and then the Eurozone crisis and then negative rates in the Eurozone. But I think we are now starting to see investors once again questioning whether the US is quite the reliable partner or the reliable ally in the context of the NATO discussions that we've also been seeing over recent weeks. And I think that's going to question whether the flows are going to be the same sort of magnitude as we go forward. And I think what we might find is that those Eurozone current account surplus areas, or whether it be the Eurozone or whether it be Japan, have a degree of crowding in and of investment, and that will probably provide a stronger narrative for both the euro and the yen over time.
Right, yes, we were talking to Jane Foley earlier on from Rabobank, and she was saying that the euro, get the words right, the euro had done a good impression of a reserve currency over recent sessions. I mean, is that the way you think about it? Simply because she said it's not been around that long, 25 years, and various other reasons that you point out?
Well, indeed. I mean, obviously the issue in terms of the eurozone, if it really wanted to be a reserve currency, it needs to have the depth of capital market, and of course we have the depth and liquidity of the bond market, and investors have obviously been buying into bonds quite significantly of late. But of course there are other markets within the eurozone where investors are perhaps a little more reticent, despite some of those yield pickups. But I think it is the case that the eurozone is once again seeing increased focus and increased interest, and so I think we will see over time that sort of euro reserve holding starting to move back higher again, and those central banks and reserve managers that were obviously put off by holding euros during that negative yielding period starting to progressively coming back. So I think that's going to be the process, and it's what I call passive diversification. As countries accumulate more and more reserves over time, I think the proportion of those reserves held outside of the dollar will gradually increase.
Okay, and do you think that, I mean, the strength of the euro that we've seen of late, in some people's view, is enough to at least ask questions about whether we get a 50 basis point cut this time around from the ECB? I think consensus is just 25 basis points, but how are you thinking about Thursday?
Yes, I think it's very much a likelihood of a 25 basis point move. I wouldn't be surprised that after the event we get some of the source stories suggesting some of the hawks, perhaps Ms. Holtz from the Austrian Central Bank, for example, are perhaps rather less happy with the idea of continued policy easing. I don't think the appreciation of the euro is going to create any real significant discussion regarding 50 basis points. Yes, it may be mentioned at the margins, but I think we are still in the realms of more normal policy adjustments for 25 basis points here. And of course, it's a meeting where we don't get updated staff forecasts, so it's not as though there's going to be a significant driving factor. Yes, Madame Lagarde will underline the uncertainties around the growth dynamic and the inflation construct via tariffs, and I think that probably underlines the fact that a sensible, gradual strategy probably still remains very much evident.
Now, there seem to be a lot of people who say China owns a lot of treasuries, but is not going to use them as a weapon in this trade war against the United States. And part of the reason for that is what it would do to its own holdings, but also what it would do to its currency. So what do we need to know about its currency management, Jeremy, at this point, that helps us understand what they do with that treasury holding?
Well, I think, obviously we've seen a gradual paring back in terms of the treasury holdings. I don't think they will necessarily start to sell them, but I think even in the context of the debate about further inflows or further flows, I think has an important dynamic. So in a sense, that was one of the reasons, rationales. It wasn't necessarily that they were selling treasuries last week, and I think probably Mr. Besant is probably going to be right in that regard, but it's at least the perception of flows not going back towards that treasury market will start to have a diminishing or a detrimental impact in terms of treasury performance. I think in terms of the currency, I think the authorities will be happy to tolerate a slow but gradual cheapening up in the nearer term. I don't think they're going to be using the currency as a trade weapon either. And I think in a sense the Chinese authorities will be very keen to make sure they provide stimulus and support for the key dynamics for the Chinese consumer. That relates to the real estate market and that relates to the equity market. As long as those channels remain well supported, then I think that can drive the consumer narrative and will help to offset some of the trade concerns.
What could create a dollar bounce? We've seen little bits, but nothing substantial. Are you watching for something?
Well, I think what we've seen is we've seen a substantial and very aggressive move in a very short space of time. So I think a degree of consolidation. So I think people will probably be hoping that in this Easter week there may well be a little bit of a paring back in terms of the news flow in a sense, and perhaps we can get a little bit of a stabilization in that particular context. I think, though, we're in a reality where people are looking for any dollar rallies to provide opportunities to start to get long again. So if we see euro-dollar, say, at 112.5, that's probably a good buy signal once again. So I think it's a case that we've moved a considerable distance. We've seen positioning change very significantly. A pause and or a paring back of the tariff news for a temporary period and a little bit of resilience in the equity market might just provide a little bit of resilience or a rally in the dollar. But I think that would just provide better levels for investors to come back to look to sell again.
Okay, Jeremy, thank you very much. Jeremy Stretch, head of G10 FX strategy at CIBC. Coming up, somebody has been making a lot of money out of some of the volatility out there, and we've heard a lot from Wall Street banks on that front. They continue to report earnings, with Goldman's traders notching up records. That's certainly on the equity side, while Citigroup and Bank of America hit the spotlight later today. What should we expect? We'll bring you that preview next. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Markets will likely continue to be volatile until we have further clarity. The administration's focus on trade barriers and strengthening the U.S. competitive position is commendable. At the same time, it is important to recognize that few companies have benefited more from a post-World War II economic and financial order than the U.S.
David Solomon speaking during Goldman Sachs' earnings call yesterday. Bloomberg's Charlie Wells is here to bring us up to speed on everything we've heard so far and what we're likely still to hear from the banking sector. Charlie.
Yeah, Anna, so we're entering that final mile of the big bank earnings season for that first quarter. And, you know, the prior quarter was actually very great for a lot of these banks, particularly on that equities trading front. But what everyone really cared about and has continued to care about in this earnings season is what these banks' projections were going forward, given the state of the trade war. And what we heard from Goldman yesterday, well, we actually didn't hear that much about tariffs. It was not mentioned on that call at all. But we did hear about material impacts of a long-standing trade war and a hope that these issues could be resolved quickly, also a hope for deregulation. And a lot of the ideas that were being presented earlier on after the Trump victory in November. On tap for today, we're going to get Bank of America and Citigroup. And again, the questions here are going to be, you know, what exposure do these large institutions have to a potentially protracted trade war? What exposure, say, does Citigroup have due to the fact that it has quite a large card business, that it gets a lot of its revenue from abroad? and questions as well on Bank of America, what their net interest income trajectory could look like if we get to a place where the rate picture is just not as positive for that bank. So we're expecting, some of this confidence that CEOs have been expressing, but also an admission that there's a lot of uncertainty still.
Okay, Charlie, thank you very much. Bloomberg's Charlie Wells with the latest on the banking sector. Let's stick with this theme and bring in Joost Beaumont, who's head of bank research at ABN AMRO. Joost, let's start with the positives, shall we? And where many in this sector, I was going to say Goldman, but actually I think it applied to JP Morgan, Morgan Stanley as well. The bright spot around equities trading, and no surprise, I suppose, given the amount of volatility and the volume, the volume demand that was created by all those news headlines. Is that sustainable, Joost?
Now, at least it's maybe as good as it gets. And of course, indeed, I think that's the key takeaway from the Q1 numbers so far in the US is that especially the investment banks benefited substantially from the volatility in the markets. Equity trading, of course, April Liberation Day was in Q2, so that might bode well for earnings this quarter as well. But like you said, there are a lot of dark clouds hanging over the market, and it remains to be seen whether they can keep up with the pace of this.
Yes, where do you think those dark clouds manifest themselves then, Joost, for the sector? Is it going to be the more consumer-facing businesses where if we see some kind of consumer downturn as a result of higher prices, that's the way that this comes through and hurts the banks? What's the feed into? How does this feed into the banking sector?
Yeah, I think it's a bit twofold. If you look at the mainly retail-focused banks, of course, they will be hit. Of the biggest risk here is NPL, so non-performing loans. How will their customers behave? We see, of course, in the US, delinquencies of credit card loans, but also car loans are rising quite substantially. At least the direction of travel is heading north. So we could definitely see more pressure on US households now that we will enter a stagflation period. So NPLs are likely to rise. Of course, also banks need lending growth with rates remaining higher for longer. And with the uncertainty that is clearly there, it remains to be seen whether investments will pick up. So lending growth is likely to remain quite meager as well, which will definitely be a challenge for banks and to keep their net interest margins at solid levels. But that's more for the retail banks, and of course the investment focused banks. I think Goldman already showed it earlier. The M&A activity with the higher rates, and also again the unpredictability about the future. Has led to kind of collapse in M&A activity.
Yeah, it seems that M&A not quite what some had expected at the start of the year, the turn of the year. Expectations were higher. What about on the regulation side? We heard from David Solomon yesterday. He listed quite a lot of areas where he had high expectation around deregulation, so capital, leverage, liquidity, supervision. What's your expectation there, Joost?
In terms of regulation, of course, there's clearly more globally currently kind of an urge to deregulate the banking sector. I think we need to treat this a little bit with caution. If we get too much deregulation, that could sow the seed for some damages along the road. In coming years. I have to think about the Silicon Valley Bank, which benefited from some deregulation in 2018, but in 2023, of course, it went bust. Maybe different reasons, but I think we need to treat deregulation with caution. Of course, it can benefit banks, but the biggest challenge is really the real economy, the risk management. Which clearly comes to the fore now, and the banks that have this in place will do better than the others.
Joost, just very briefly, do we get any changes in regulation quickly?
Change the regulation doesn't go very, very quickly, but we might get some that could be supportive, but challenges remain quite large, to be honest.
Joost, thank you very much. Joost Beaumont, head of bank research at ABN AMRO. Coming up on the programme, we'll get back to some of the sectors that are on the move this morning, and certainly high up on the list then is luxury. The luxury giant LVMH really underwhelming, reporting a 5% drop in revenue in its largest division. Both the US market and the Chinese market under pressure, not delivering what analysts had expected. We'll discuss the sector's slowdown. Is it limited to those leather and fashion items? How did Sephora perform? What impact is this having on the rest of the sector? We'll get into that conversation next. This is Bloomberg.
In case you missed it on the close.
I think our sports fund is very exciting. We've invested in a number of new leagues that are doing exceptionally well. A number of the investments we've made, we've already seen prices that have gone up already about 50% plus. So what you find in new leagues and new teams is if you're right, it's going to grow exponentially, right? So the whole key and the nice thing about that is you see the ratings the next day. So I can tell you if it's grown, like we've invested in PBR and professional bull riding. That league is growing 30% plus a year.
There's professional bull riding?
Yes, do you want to get on a bull? You'll end up, if you could stay 8 seconds.
I know, this sounds awesome. Do I have to go I don't have to go to rodeo for that. That's
No, you could do it. We are here in New York.
Okay.
We own the New York Mavericks, so you can come anytime you want to go.
Okay.
Come, you'll love it. Yeah, we'll chat offline.
Don't miss the close, live every weekday.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Good morning and welcome to the Pulse. I'm Anna Edwards in London, in for Francine Lacroix this morning, and these are your top stories. Auto shares drive gains in Europe after President Trump floats a potential auto tariff pause, but reiterates new levies on pharmaceuticals and semiconductors are coming. U.S. Treasury Secretary Scott Bessent rejects speculation that foreign governments are dumping U.S. debt. We'll bring you more from our exclusive interview. And a Bloomberg scoop, China orders its airlines not to take any further deliveries of Boeing jets as the trade war with the United States reaches new heights. We have movement in the luxury space this morning, and that's where we will begin this part of the program. LVMH shares dropping after the group published weaker than expected sales, weighed down by sluggish demand for high-end goods in China and the United States, and the threat of a trade war. We have on hand, of course, Andrea Felster from Bloomberg Opinion to talk us through what is happening here. Andrea, good morning once again. So what does this tell us then about luxury demand? What did we learn here?
We didn't learn very much, actually. So the biggest swing factor
was a year ago, lots of Chinese consumers were going to shop in Japan to take advantage of the weak yen. That's still happening, and they're still buying at home to the same extent. But it's not as spectacular as it was a year ago. So that's sort of, mathematically, that's dragged on the performance. In terms of tariffs, the US demand for fashion and leather goods and watches and jewellery is held up. Now, there were two areas of weakness. One was Sephora. That also had very strong growth a year ago, so we might be getting some comparison. And also wines and spirits. Now, Sephora and wines and spirits could have been hurt by the tariff uncertainty because both of those appeal to a broader consumer base, i.e. not the super wealthy, who tend to be more affected by inflation, slowing growth, employment market. So that we could have a bit of impact there. We haven't seen a broader impact yet.
And what about the read across into other businesses then? Is this LVMH specific? A look at the luxury names in Europe tells me no, that there is read across into both other luxury businesses, but to your point about drinks, into a wide range of luxury businesses and drinks makers.
Exactly. Concerns about L'Oreal, given the Sephora, all the drinks makers sort of worried about whether we're going to see a pullback from tariffs. It's interesting that all of the luxury brands have been hit, and you've got Hermes, which hasn't fallen by as much, but it's still down. Richemont, those two are probably more insulated. Obviously, we all know Hermes has got waiting lists for its bags, so if demand falls, it can simply, go to the next person on the list. If the person at the top of the list doesn't want the Birkin, there'll be someone else who does. Richemont gets more than 50% of its sales from jewellery, and jewellery has proved to be more resilient than fashion and leather goods, because actually, although jewellery is expensive, the prices haven't gone up as much as for handbags. So there's also a bit of a maturity. We've all been buying handbags for the last 15 to 20 years. Jewellery is something different and at a slightly lower stage in its development than fashion and leather goods.
Yeah, and if I look at some of these luxury names, some of them have had a really tough year, haven't they?
Yeah.
I mean, it doesn't matter if you go back year to date or back 1 year. I mean, I'm looking back 12 months, and we've got Kering down half its value, 52% weaker. Yeah. It's wider than just luxury. It's other consumer names as well. Puma, for example, but Burberry, Christian Dior, LVMH, all a tough time. So these stocks have come off a lot, Andrea.
Now, I think the corollary to the Hermes Richemont story is if you're in a transition like Kering's Gucci or Burberry, it's much harder to do that in a difficult market. So Gucci's got a new designer trying to revive excitement in the brand. That's going to be much more difficult because when times are tough, we tend to gravitate to the names we know. We don't want to take a risk on a new designer. Is it going to stay in fashion? Is it going to hold its value? So their job just got much harder. Despite those share price falls, I'm not sure that's fully reflected.
Okay, Andrea, thank you very much. Andrea Felsted from Bloomberg Opinion with the latest on that sector and how it's faring in today's market after those numbers out of LVMH. Well, one of the areas of weakness, of course, was China, and let's stick with the China theme. China's president is calling on Vietnam to jointly oppose what he calls unilateral bullying to maintain global free trade. Chinese state media says Xi Jinping made the comments during meetings with Vietnam's leaders yesterday. US President Donald Trump imposed a 46% tariff on Vietnamese goods before announcing a 90-day pause. Vietnam is seeking more balanced trade with China and cooperation on security. Meanwhile, US Trade Representative Jameson Greer tells Fox News that we can expect talks between Donald Trump and Chinese leader Xi Jinping in the near future. This comes amid an escalating trade war between the two countries.
China is the only country that actually implemented its retaliation and set it on this course. So obviously that's concerning, and the president has been very clear that he's willing to talk to his counterpart and that he expects that at some point we'll have talks. We're not there yet, but that's his expectation, and I share that expectation.
Joining us now for more on China then, Yi Zhe, Senior Research Fellow on China in the Asia-Pacific Programme at Chatham House. Very nice to speak to you, Zhe, about what's going on here with China. In terms of cooperating within the Asia region, do you see prospects for more collaboration with China from Vietnam, from other countries in the region who maybe in the past have built alliances with the United States but now are not quite so sure of those alliances?
Thank you, Anna, for having me. Obviously, I think the answer is yes. Yes, for the reason, it's not exactly just for the economic rationality. I think it's mostly for the reason of being predictable. I think part of the reason for what Donald Trump has introduced, the tariff, imported into Southeast Asian countries in the past week, that really is sending a shock wave across the region and make many Southeast Asian economies consider, is United States as something, a country which is reliable, and if it continues to imposing punitive tariff like this to hurting their own economy. So I think in a way, it is actually inadvertently what the U.S. has done inadvertently push those Southeast Asian economy become more integrated with China and also politically more aligned with China at the same time. So I think that's also part of the reason why Xi Jinping has orchestrated and convened a meeting on the so-called neighborhood policy meeting last week, and one of the core cornerstone of China's foreign policy from the past.
Yes. It's interesting then, we're talking about this in the Asian context, we're also talking about this in the European context, that the EU perhaps is incentivized to cooperate more amongst the nations in Europe as a result of President Trump's policy. But sticking, of course, with China in this conversation, how do you think about the tools that China has at its disposal to respond to the United States here and the tariff war that we see? Because we've seen, of course, increased tariffs, but then China said, that's it, we don't plan to go any higher. So which tools do you think China will rely on from this point?
Well, I think there's two boxes. Beijing has not really used it for now. And firstly and foremost, I mean, much of discussed domestic economic stimulus that some of the economists might expect government to unleash later in this month. And firstly, they have not used it. And I think secondly, we'll probably could see even more stringent export control on the critical minerals and also the critical minerals processing, which China has the absolute monopoly for that. Now, thirdly, I think we have not seen Beijing begin to entertain that idea of dumping the U.S. treasury bond. So I think there's three things that we have not seen so far. But also, I think on the other hand, the part of the reason why Beijing does not want to play this number game anymore is actually give a step for Donald Trump. Donald Trump can rightly justify to his domestic audience by saying, look, because of my maximum pressure towards China, and this has actually allowed me to play with the long game with Beijing. So actually, I think both sides will have some game to play in here. Although, I mean, judging from the previous interview that you have recorded with USTR chief representative, I mean, I doubt the Chinese really want to enter in some kind of negotiation for now. I think they're going to be hanging there for quite a while.
So you think we're in this situation with this elevated tariff regime for quite a while then, Jia? You don't think that negotiations happen quickly at all?
Well, I think what Beijing sense is that if Donald Trump wants to play defiant, and then Beijing is willing to play this sense of defiance over a long way, and also this is part of the reason that the Chinese export is relying far less towards the United States than compared with 8 years ago in the first round of the trade war. So that sense of over-reliance towards the United States has significantly reduced, and this actually offers some sense of buffer for the Chinese manufacturers. So I think that's the reason Beijing is not really willing to play a long game in here.
And what about the use of treasury assets? What about the use of China's holding of US treasuries? You said that, this is one of the tools they have at their disposal. Lots of guests, though, tell us they're not going to use it. But I did see one Bloomberg economist writing yesterday that China might not have to sell very many treasuries to lean into a lack of enthusiasm for treasuries at this point. If the wider market is not very keen on treasuries, then it might not take China to sell very many to have a big impact. Is that something that you think, an argument that China is thinking about?
Well, I think it's less about the economy and financing here. It's more of the psychology. And if Beijing, as the largest holder of U.S. treasury bonds, began to entertain this idea of dumping U.S. treasury, I think perhaps other countries may follow the suit. So this actually would lead into a further market turmoil. So I think it's more on the psychological factor that Beijing is now putting a threat of doing this, but not actually doing it. So that's where we are.
Yeah, we've seen China, just our story just moments ago, in fact, saying that China has asked its airlines not to take further delivery of Boeing aircraft. I suppose this is the kind of policy that we could see. It will. These are big ticket items, big, expensive, capital goods items. That could be an area of focus.
Well, this is one area for aircraft, but there's another area which we have not discussed so far is on agriculture products, which is the make up the majority of U.S. import towards China. I think part of the reason for this is that China also look into who are the MAGA core supporters. And of course, there's a certain sectors of American agriculture sector support Donald Trump wholeheartedly. So China would actually be making those farmers hurt the most and hoping that those farmers and also the activist group will be able to persuade Donald Trump to withdraw the tariff that imposing on China. So I think really on agricultural products, we're probably going to see a very similar pattern that China are going to continue to be refusing import from the United States and instead looking for alternatives, and which has already looked into alternatives in the past few years from Brazil, from Argentina, from Russia, and from Ukraine. So I think the agriculture sector is also worthwhile to look into.
Yes, that's worth remembering from the first Trump administration as well, isn't it? Thank you very much for joining us. Then, Zhijia, thank you very much for your thoughts. Senior Research Fellow on China in the Asia-Pacific Programme at Chatham House. Now, she was just referring there to the interview we had with the US Treasury Secretary, Scott Bessent, who is hitting back after China's finance ministry called President Trump's 145% tariff on the country a joke. In an exclusive interview, Bessent told us there could be a decoupling between the world's two largest economies. He also says he's committed to getting trade deals done with several other countries in the next 90 days.
I think now that we have the China tariffs in place, that they are going to want to have some protection from Chinese goods flooding their markets. That China's business model is like from that Disney movie where the brooms are carrying the buckets. Like they're not going to stop manufacturing because the U.S. has a tariff wall up. So those goods are going to go somewhere.
Where do you think they're going to dump?
Well, I think it depends on the good.
Well, we have exemptions now, though, for electronics, so we still expect electronics to come into the United States with the smaller tariff rate, the fentanyl, 20%.
But you were asking where are they going to dump. I think it will depend on what is the good. You know, higher value-added manufacturing goods, likely in Europe, Canada, in the G7, and then kind of more of the baubles and knickknacks in the global South.
China's Commerce Ministry came out when the tariff rates were going above 100% and called it, quote, a joke. Has there been negotiations on any level between Beijing and Washington right now?
Well, look, it'll come from the top. President Trump, Chairman Xi have a very good relationship. And I wouldn't say that these are not a joke. I mean, these are big numbers. I think no one thinks they're sustainable, wants them to remain here, but it's far from a joke.
Well, they just say that the rate is so high, it's become a joke. Basically, does it just stop trade between Washington and Beijing altogether? Do you see a decoupling of these two economies?
Well, maybe the trade minister has a different sense of humor I do, but I don't see anything funny about it.
Do you see a decoupling, though, between Washington and Beijing?
There doesn't have to be. There could be. There's a big deal to be done at some point, but look, what is different with China that is different in the history of trade, that normally, if you go back to the big trade deals or the currency deals in the 80s, the Plaza Accord, the Louvre Accord, the Reagan auto deals, our leading economic competitors were our military allies. China is both our biggest economic competitor and our biggest military rival. So that's going to require a special kind of formula.
Are you teasing out a Mar-a-Lago Accord that we should be paying attention for in the future?
I'm not sure what you're talking about.
Well, potentially getting all these trading partners together to discuss fair, balanced trade?
Well, we're doing that over the next 90 days.
U.S. Treasury Secretary Scott Bessent speaking exclusively with Bloomberg's Anne-Marie Horden in Buenos Aires, in fact, talking about those global tariff conversations. Coming up, President Donald Trump floats a tariff reprieve for automakers as US-EU negotiators try to reach a deal. We're live in Berlin with the latest on the EU tariff conversation. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
I think there will be advantage to our allies, especially, and a first mover advantage. Usually the first person that makes the deal gets the best deal. So
who do you think will be first?
It's their choice. I think there could be numerous countries. We're going to move with all deliberate speed. And again, it's going to be a process. The tariffs are the easiest part. So a country with high tariffs, you can just say, okay, this, get rid of it. It's the non-tariff trade barriers that are more insidious, more difficult to spot. And it's probably going to take a little longer to exercise those demons.
That was the US Treasury Secretary Scott Bessent speaking exclusively to Bloomberg, of course. Now, the EU Trade Commissioner, Maros Sefcovic, says the EU is ready for a fair deal with the United States after meeting with Commerce Secretary Howard Lutnick. For reaction from Europe, let's bring in Bloomberg's Oliver Crook, who's in Berlin and has been tracking this. So we heard very limited lines, I think, from Maros Sefcovic, but a bit of detail in there then, Ollie. What is the latest on those US-EU negotiations?
Yeah, and everybody wants a fair deal. Everyone has a different idea of what exactly that means. So Maros Sefcovic had a basically 4-hour meeting with Howard Lutnick and Jameson Greer yesterday in Washington, D.C. He's coming back now to Europe to brief European diplomats in terms of the fruits of those labors. He put out this tweet after that conversation saying that the EU remains constructive and ready for a fair deal, including reciprocity through our 0-for-0 tariff offer on industrial goods and the work on non-tariff barriers. So let's just break down those two sort of sides of the coin. The 0-for-0 is basically 0 tariffs for 0% tariffs on industrial goods. This effectively would erect a free trade zone between the EU and the United States. And we should say that before the sort of new tariff regime that's been installed by the Trump administration, you were not exactly at 0-for-0, but the sort of trading discrepancy in terms of tariffs between the EU and the United States was only about 0.5 percentage points, right? It was very small to begin with. So the U.S. administration is really going to be looking for a lot more, and what they're going to be looking for are these so-called non-tariff barriers, these sort of exercising the demon of the non-tariff barrier. The problem for the Europeans is that the U.S. administration has still failed to identify what exactly these are. When you ask For example, Peter Navarro over the weekend, he says he wants to target a value-added tax, which is basically a sales tax in Europe. You talk to European officials about that, they say this is basically just a sales tax on goods not only imported, but also domestic goods in Europe. That is basically off the table. We talk about food safety standards. We heard about beef again from Donald Trump yesterday. There are other places where you might actually be able to make progress. We heard from the German finance minister last week. They're talking about potential regulations on automobiles. If you had the same regulations in Europe as you had in the United States, a car that's produced in Detroit could be sold into Europe basically with no other changes to the car because the two regulatory regimes are aligned. But Anna, really the fine line here, I think, is for the Europeans trying to give something to the United States on this question of non-tariff barriers, while at the same time not appearing to basically be taking legislation from Washington, D.C.
Yes, it does seem as the US administration does want to see more US cars being sold in Europe. I'm just not convinced that they will all fit on all of Europe's roads, but maybe that's a challenge that the US administration would like to take and prove that it's possible.
Non-tariff barrier.
Yeah, exactly. There we go. What about the China-EU relationship at this point? We've heard from Spain quite a lot recently that they would like to see that as an area of more focus.
Yeah, so what's interesting is the Spanish really are sort of outliers, I think, in this discussion. What we've heard from Spain is that they want to have stronger diplomatic ties with China, stronger economic ties with China, more investment from China within Spain and the European Union. That is a notion, despite the sort of erratic activity from the United States, that has not really gained a huge amount of traction in broader Europe, right? You talk to other officials from other countries, they really do not want to move closer to China because remember, Anna, before Trump was elected president of the United States, the main economic threat to the continent of Europe was perceived by the Commission to be China. What we are now seeing, and I think is interesting, is potentially a development in the United States where you have a slight disagreement between Scott Bessent and Donald Trump, where Scott Bessent, it seems, would like to get some of these allies on side. He'd like to sort out the trade questions in order to potentially form a more collective approach between the United States, between the Europeans and others against China potentially on trade. For the Europeans, as far as they're concerned, that is pushing a little bit on an open door. This is something that the Europeans are alive to, the risk that the Chinese economy poses to the European economy. That being said, until the Trump administration, and really Trump is the only one who's going to be making this decision, decides not to wage war on everybody at once, it may be difficult to get that collective approach. That being said, it is something that the Europeans could potentially be open to.
Oliver, thank you very much. Bloomberg's Oliver Crook with the latest on the EU-US relationship and the EU-China relationship as well. Well, let's have a quick look at where we are on the US futures picture then as we move more towards the US portion of the day. This is the futures picture then up by 0.2% on E-minis. NASDAQ futures up by 0.3%. So off highs a little bit. We have, of course, seen a real pullback in equities as a result of nervousness around tariffs. We're unwinding some of that today, and the things that President Trump has said around autos, tariffs, and perhaps a little bit of willingness to show some flexibility and reprieve on the autos front, that's certainly helping here in Europe, and we'll see what that continues to do over in the United States. If we see pullbacks in stocks, do they represent a buying opportunity? We heard from the CIO over at Deutsche Bank a little while ago.
Yeah, we've said we buy the dip in the market if it's closer to recessionary levels. And I think the top, if you look, was mid of February, 6,100 in the S&P. So I think whenever you see or have seen levels below 5,000, 4,800, we think that's rather a buying opportunity. And we have not changed our view on this one. So I do expect more volatility, but whenever we go closer to recessionary levels, I think it's a buying opportunity. Let's not forget, I think there's still a lot of potential growth rate in the US, and that's something which is still interesting for investors from our point of view.
Yes, it was just months ago we were getting so excited about US corporates and AI and the links there and the exceptionalism there. We will see how long it takes to return to that theme for the global investor community. That was Christian Nolting, Deutsche Bank's global CIO there. Let's have a look at how some stocks are performing today, in particular the auto sector. We'll get to luxury in just a moment. But in terms of the auto space, we see some real movement here. This on the back of those comments from President Trump yesterday saying that he is looking at the idea, floating the idea here that we could see some kind of temporary reprieve for the auto sector and auto parts sector. There wasn't a huge amount of detail in that, but it was enough to send US automakers higher during their session. It then filtered through into the Asian session, and we saw some of those moving higher, and into Europe as well. So we see Stellantis, of course, with its substantial US presence, up by 5.2%, and it is helping some more of the European automakers as well, or more European makers, Mercedes, BMW, for example. On luxury goods, let's have a look at that one, because this is another sector very much on the move, but to the downside. And this is to do with tariffs to some degree, but also just to do with the earnings story that LVMH presented. Partly this is China-driven, so weakness in the Chinese sales number there, not as much as they'd expected. There are other tariffs we could talk about on cognac, for example, over in the Chinese market. And then in the US side of things, LVMH also disappointing with what it reported on the US consumer. And that, as you can see from the board there, is weighing on sentiment across other luxury names, so Burberry, Kering, Hermes, and as Andrea Felted was telling us earlier on, those businesses that are trying to turn around luxury, it's even harder for them perhaps to do that in this difficult overall luxury environment. Ericsson, also worth a mention, this telecom equipment company up by 6%, and this is an earnings story, but is this just earnings that have been pulled forward ahead of tariffs? That seems to be one of the conclusions you could get from reading some of our coverage on that, the business this morning, but the stock is up by 6.3%. Now, I mentioned what's been going on in some of the industrials, the automakers sector earlier on. Later today, we will be speaking with the Hyundai CEO on how South Korea's largest automaker will try to navigate Trump's tariffs. That conversation will be at 3:30 UK time, so that'll be an interesting one to tune in for. Up next, a Bloomberg Brief will take you into all of the stories you need to know ahead of the US Open. This is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
We'll have to see over the next 3, 6, 9 months how the tariff discussions play out and what does it mean.
I do factor in some effects of tariffs now on inflation, on prices.
I like the idea of the 10% tariff across the board.
I've spent my entire career focused on fiscal discipline. I don't think these people have the foggiest notion what they're doing. And I think DOGE is doing tremendous damage to government.
Elon Musk is probably the inventor of our age, but who understands that we're in the midst of the most profound convergence among technologies.
When we are facing a once-in-a-generation technological disruption,
we cannot close this retirement gap without private-public partnership. We have to have good policy.
Do you think, Dawn, that the market is correct to be, as of now, pricing in 3 rate cuts in 2025?
I would take the other side of that bet.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
A deal is going to be made with China. Nothing's over yet.
There's been a lot of confusion up to now.
A 90-day pause is not an eradication.
Where is this leading to?
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Good morning from our global headquarters in New York. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. More tariffs coming soon. The Trump administration initiates probes on pharma and chips. But a possible break for autos. President Trump considers pausing his car maker tariff, giving them more time to set up in the U.S. And to Traders Paradise City and Bank of America report results as the big banks bring in a record haul for equity trading. Well, you've got your first back-to-back gains for equities since Liberation Day. You're looking at adding some weight to that for the S&P 500 futures index, up 0.1%. NASDAQ 100, that outperforms, up 1/3%. Russell 2000 futures struggling to hold on to any gains. Sentiment may be getting a positive boost from relief for the automakers, but more tariffs are coming. Meanwhile, there's also stability in the Treasury market. This morning, you're looking at little change for the front end of the curve, getting a boost from Chris Waller yesterday, the Fed governor, speaking about the idea of front-loading rate cuts, and inflation being a one-time off. Meanwhile, your 10-year yield down 2 basis points, your 30-year yield down 2 basis points as well. Your 10-year trading at 4.35. Let's get underneath the surface and look at some stocks to watch with this morning. Here with that is Bloomberg's Joe Easton. Good morning, Joe.
Morning, Danny. So Boeing shares dropping in the pre-market as China tells its airlines to stop taking deliveries of Boeing jets in a retaliation following Trump's 145% tariff on Chinese goods, though we can see Boeing down around 2.7% in the pre-market this morning. And I'm also looking at autos, despite that positive news on potential reprieve for the sector. Barclays today downgrading the sector to negative, saying the risks from tariffs is not yet priced in on either a supply or a demand basis. And they cut General Motors this morning, so we can see that one falling 1.1%. And then over in chips, we've got a deal falling through on Semi's purchase of Allegro, no longer going to take place because the companies haven't been able to agree on a final price. We can see that stock absolutely slammed in the pre-market, down around 12% for Allegro. And as usual, all of these moves and more available on the before the bell opening wrap on the terminal at the moment. Danny.
A tough environment for deal making, Joe. Great work as always, Bloomberg's Joe Easton. And in just a few moments, we're going to be catching up with Laura Cooper of Nuveen. Later in the hour, we'll be speaking with Amy Wu Silverman of RBC Capital Markets and Stephen Bigger of Argus Research on the big bank earnings, conversations you do not want to miss. Now, when it comes to sentiment in this equity market, Bank of America's Global Fund Manager survey says a record number of global investors intend to cut their holdings of U.S. equities. It also shows the largest 2-month drop in equity allocation ever. Joining us now is Laura Cooper, Global Investment Strategist and Head of Macro Credit at Nuveen. Laura, there feels to be more calm in the market today, but how do you assess where current market sentiment stands with statistics and superlatives like that?
Well, I think the current market sentiment is taking a cue from the fact that we are seeing a bit of a paring back in terms of those tariffs. But while this is incrementally kind of supporting sentiment, I think this just adds to the degree of ongoing uncertainty facing investors. We're still going to see, what is the actual end game of these tariffs that is going to continue to feed through into the confidence channel that's going to weigh on corporate profit margins. And that does suggest that risk assets are going to trade in this very choppy price action.
You see the market really hanging on to any positive news we get out of the administration. Late yesterday was an idea that we would get some relief for the automakers, and then it flips to this idea of more sectoral tariffs. But Laura, for the moment, we seem to be wanting to trade on the good news at a time where we still have 145% tariffs on China. How much relief can you take? Are these opportunities for dip buying?
I think there are potentially opportunities, given market volatility, to find, allocations that have been kind of hit by this indiscriminate selling. But I think market attention will now turn to the earnings season ramping up. We'll be watching for guidance coming from corporates. Are they going to be more conservative, or are they going to outright withdraw their guidance? We'll be watching for any cues on corporates' take on this ongoing trade war, kind of the evolution of recession risk, and then importantly around what the consumer demand backdrop is, because we are going to see this tariff begin to weigh more materially on the hard economic data, because as of now, it's really only hit that survey sentiment indicators.
At the same time, Laura, you have company earnings. As you said, we've started to get some hints of what we might see, but it's been extremely uneven. Walmart saying that they're going to absorb the price increases. LVMH reporting today saying that they would need to raise prices. How do you assume what margins look like? Are we about to enter a period of margin compression?
I think that probably is the case, just given the starting point has been, historically elevated margins. And I think if we look at what kind of the backdrop has been heading into this earnings season, we did see earnings revisions for the U.S. come down about 6 percentage points, but even now they're sitting still quite elevated, just above 11%. So our expectation, as we start to see this uncertainty filter through, as we start to see the actual impact of these tariffs as they come into play, weigh on the bottom line of corporates, then we're going to see further downward revisions to earnings. And I think that provides, another potential catalyst to keep risk assets on the back foot.
There still really seems to be this idea, at least it's being talked about in a way that it hasn't been before, Laura, that we've reached peak U.S. assets and peak U.S. exceptionalism. In the Bank of America survey, 73% of respondents said that U.S. exceptionalism has peaked. You can see that in what the dollar has been doing. It's been weakening, not catastrophic levels, but that is a trend that continues. Laura, is there a sense that that narrative has peaked?
I think that is kind of the consensus take at this juncture. I think it's kind of taking a step back. The active debate is, are we seeing kind of cyclical forces at play in terms of that U.S. rotation, or is there actually more of a structural shift taking place? We have upside inflation risks in the U.S., downside growth risks on the back of tariffs. We clearly saw, the U.S. 10-year term premium in the bond market rise to quite elevated levels on the back of fiscal uncertainty. So there's that confluence of factors at play. But on a structural side, we are seeing less confidence in the U.S. dollar, less confidence in U.S. assets. And I think that is going to continue to support this rotation away from from U.S. assets into places like Europe because of that support from the fiscal impulse. But I think it's going to be this ongoing gradual rotation over time as this structural shift really comes back into, it makes more of a pronounced market move.
I think it was the Treasury market last week, along with the dollar, that really had some people frightened. Laura, I just want to play you some sound from Anne-Marie Hordern's interview with Treasury Secretary Scott Bessent when she asked him what tools he has to try to alleviate any concern in the bond market should that become necessary. Take a listen.
Well, look, the Treasury has lots of things we can do, and but again, I think we're a long way from that. But again, we have a big toolkit that we can roll out. We do regular off-the-run buybacks. We could up the buybacks if we wanted.
Of course, I just want to point out there is a little bit of irony there, considering that he had been so critical of his predecessor for using tools from the Treasury to try to manipulate the bond market. But Laura, what do you understand as the puts coming from this administration, be it a very structural one, a very technical one from Bessent, be it Trump talking down from tariffs? Just what is their threshold for being able to take some of the market pain?
I think we saw kind of the magnitude and speed of the moves in the Treasury market last week really suggest that that is where that so-called Trump put is, focusing on that 10-year bond market. I think, though, the key question is, from a Fed perspective, we're likely going to need to see a liquidity event, a significant seize in the market, more of those significant market dislocations for them to actually intervene. I think this is a backdrop where the inflation risks are tilted to the upside. There's so much uncertainty about what the growth spillovers could be from this trade policy that the Fed, I think, has the optionality to take a wait-and-see approach and really not step in to use some of their tools unless we, again, see the significant moves that we saw last week, but perhaps on a persistent basis.
That is what most Fed officials have been saying, but I gotta say, Governor Waller sounded kind of different yesterday, Laura, saying that kind of seeming like he would prefer to front-load rate cuts and that inflation would be a one-off using the dreaded transitory. I just wonder what you make of his comments yesterday.
I think what struck me about Waller's comments yesterday was the fact that he outlined different scenarios. And that's something that we're doing at Nuveen, right? We're looking at a number of different outcomes on the tariff front and trying to create kind of a probability-weighted scenario for the U.S. growth and inflation outlook. And based on that, we think core inflation this year could be, 3.5% and even higher than that. That's not a backdrop that the Fed is necessarily going to be comfortable in front-loading rate cuts if the bond market continues to show stability, it's really when we expect to see that soft data deterioration start to feed into hard data. That's when we could see the catalyst for the Fed to actually, potentially cut at that more aggressive pace that Waller is alluding to. But I don't think that is really a story. Perhaps, June, July, when the Fed meets. I think in the near term, tariffs, we don't know the impact. We don't know whether they are going to be transitory or not. So I think that's going to be the key kind of calculus in terms of the Fed thinking.
Yeah, a great quote from Savita Subramanian in Bloomberg today saying tariff modeling is a fool's errand, certainly not an easy task. Laura, thank you so much. Laura Cooper there of Nuveen. Let's get you some other top stories that are trending on the terminal this morning. China has ordered its airlines not to take any more deliveries of Boeing jets. It's the latest salvo in the expanding trade war. Sources tell Bloomberg that Beijing has also asked the carriers to halt purchases of equipment and parts from U.S. companies. President Trump's special envoy Steve Witkoff says his talks with Russia's Vladimir Putin last week were, quote, compelling. According to Witkoff, they discussed steps to end the war in Ukraine and some very compelling commercial opportunities. A check on LVMH shares. They are dropping after weaker than expected sales, down some 7%. The luxury group has been weighed down by sluggish demand for high-end goods in China and the U.S. and the threat of a trade war. Its market cap has now been overtaken by Hermes. Coming up, chips and drugs are in the crosshairs for sectoral tariffs after the U.S. initiates probes. We're going to have more on that coming up next.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
A deal is going to be made with China. Nothing's over yet.
There's been a lot of confusion up to now.
A 90-day pause is not an eradication.
Where is this leading to?
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
I'm looking at something to help some of the car companies where they're switching to parts that were made in Canada, Mexico, and other places, and they need a little bit of time because they're going to make them here, but they need a little bit of time. So I'm talking about things like that.
President Trump there saying that he was exploring the possibility of temporary tariff exemptions on imported vehicle parts. Shares in U.S. automakers uneven this morning. We're down 1% for General Motors, more than that for Stellantis. Ford is slightly higher, of course, has a more domestic production line. For more of the latest on tariffs, we're joined by Bloomberg senior editor Bill Ferries, Craig Trudell, who leads our global autos coverage, and Bloomberg European correspondent Oliver Crook. Bill, let me just start with you because we have this threat of sectoral tariffs. Walk us through it. What might we see?
Well, we seem to have made a shift. A week ago, we were talking about those reciprocal tariffs on countries. The president now talking a lot more about sectoral tariffs. We've seen those on things like autos, on steel, on aluminum. The president has talked about them for things like lumber. Now he's ordered the Commerce Department to do an investigation that could take up to 9 months, looking at the pharmaceutical industry and semiconductor and chip manufacturing equipment that is imported in the United States. So based on the pace of things in this Trump administration, I don't think any of that will take 270 days. I expect we'd get something much sooner. And the implication from the White House is that that would result in new specific tariffs on those goods.
It's a lot of stop-start, though. And Craig, let me bring you in on this, because as we heard there, the president floating the idea that maybe there is a pause, a reprieve for automakers to bring their manufacturing into the U.S., but presumably that's something in a project that would take years to happen.
Yeah, I think, the president said several times there, a little bit of time. I think, the industry would absolutely need a lot of bit of time to do some of the things that he's talking about here. And I think it's pretty remarkable, too, that, the examples that he gave of sort of onshoring or reshoring into the U.S. were from Canada and Mexico. I think, one of the things the industry has really been trying to emphasize to the president is that, North American supply chain would be, not so bad, as opposed to, maybe trying to sort of wean the industry off of, parts, engines, transmissions coming from outside of North America. I don't think, based on, what we hear him say on a day-to-day basis, that he's particularly receptive to those arguments. And he wants even parts coming, from over the northern and southern borders to the U.S. And that's really going to be challenging for this industry, because there has been, a fair amount of progress toward North American sourcing. But in terms of, bringing things over from Mexico or Canada, I think it's really hard for the industry to sort of process that when this has been, a decades-long project to sort of, localize and determine and define that as North America, as opposed to just the U.S. specifically.
Craig, I just wonder if that's some of the skepticism we're seeing in U.S. share prices for car makers this morning. We're looking at some of the European ones that were up. You basically only have Ford and Tesla in the U.S. that are higher pre-market. Is there just a lot of skepticism that automakers can escape some sort of pain in this environment?
I think even if we see, some of the tariffs being taken off, they're going to incur expense to move this production, right? Or sort of shake up their supply chain, help their suppliers to be able to afford these shifts. And, in addition to the costs, sort of whether you do or don't do that, you also have still, let's not forget, 25%, import tariffs on vehicles that are imported. And so, this is a sort of, incremental, small bit of relief, but this is an industry that's still very much in the president's crosshairs, and one that he's really fixated on in terms of how he wants to sort of reorient the way the industry has been operating.
Well, beyond sectors, we also still have country tariffs that are in the mid of negotiations. Oliver, I want to bring you in on this point, because we had the EU trade rep meeting with Howard Lutnick and Jameson Greer. Was there any movement out of that meeting in terms of reaching some sort of negotiated agreement?
Yeah, so I think the Europeans are focused on basically two things, and this is due to the Trump administration's view. There's the question of tariffs, and then there's a question of non-tariff barriers. And what we got out of this readout from the conversation, we haven't got the full readout yet. I suspect we'll get that a little bit later today when Maroš Šefčovič, the EU trade rep, briefs diplomats, is on the one hand, you have this proposal from the EU where you have 0 for 0 tariffs. This is basically creating a free trade agreement between the EU and the United States on industrial goods. 0 tariffs, 0% tariffs for 0% tariffs. That is the goal from the European Union. That being said, before the Trump tariff regime, you were pretty close to equal tariffs between the EU and the United States. They're about off by about half of a percentage point, right? So it's not really going to be enough for the U.S. administration, which brings into the fray these sort of non-tariff barriers. And I think the difficulty so far for policymakers, and maybe Maroš Šefčovič got a little bit of a clue of this while he was in D.C. yesterday, is they have not been explicit about what non-tariff barriers they want to target. If you listen to Peter Navarro, as he reiterated over the weekend, they want to do value-added tax. The European policymakers, whenever you talk to them them. They say this is basically a sales tax. This applies both to domestic goods and imported goods. That's off the table. But maybe you could see some progress on, say, automotive regulations. If you have the same regulations in the United States as you have in Europe, a car that's been built in Detroit could be sold in Stuttgart or anywhere in Europe without any kind of issue. That's something that the German finance minister had suggested. So these are all sort of the conversations that are beginning to evolve between the EU and the United States. However, Danny, I think it's important to point out that while on the one hand, the Europeans do want to give concessions to the United States on these non-tariff barriers, on the other, they do not want to get domestic legislation dictated to them from Washington, D.C., and that is the fine line that they've got to tread.
And it goes further than just Europe, Bill, because we are in the midst of negotiations. NEC Director Kevin Hassett yesterday saying that there are more than 10 deals where there's very, very good, amazing offers made to us. What sort of offers do we know? Do we have any details of the different nations beyond the EU that have come to the table and agreements that might be reached?
Well, we know the administration has said they think Japan is very high on the list. You had Treasury Secretary Scott Bessent down in Argentina saying that they also would be likely high on the list for some sort of deal. And the deals, what we're hearing about, can be a bit of a hodgepodge of things thrown in. So there might be a little bit of tariffs. There might be something on the non-tariff barrier front, but there also may be investments in energy projects in Alaska, things like that. So the White House is making it clear that they're willing to consider some kind of non-traditional components to these agreements, but there's no clear listing of the things they're looking for. And I think what countries coming to the U.S. want more than anything is a little bit of certainty that the deal they make is going to be a deal that stands, that the president's not going to change his mind a few days or a few weeks later and suddenly re-add tariffs. And I think what we've seen over the last 10 days or so is a lot of the ground shifting on an almost daily basis about what is going to get tariffed, what might get a reprieve, what might get tariffed down the road. That's the kind of stability I think countries are looking for.
Well, we definitely thank you all for helping us keep track of that moving ground. Bill Ferries, Craig Trudell, and Oliver Crook, thank you so much. You're watching Bloomberg Brief.
You missed it on Balance of Power.
The statute governing the FTC says commissioners can only be removed for cause. Was there any indication that you were fired for cause?
No, there was no claim of cause, and the statute actually specifically says cause means neglect, malfeasance, or inefficiency, and there was no claim of any of those.
So as we talk about some of those other examples, keeping in mind we are having this discussion with you on the day we got a Fed rate decision, is this directly applicable to what is supposed to be an independent central bank? Is that one way in which market participants should be looking at this?
Yes, that's exactly right, and market participants should be scared. To be clear, there's no legal difference between Jerome Powell and me. In fact, he and I were both originally appointed by President Trump, and if the president can illegally remove me, he can legally remove Jerome Powell. People should be very worried about that.
Don't miss Balance of Power, live every weekday.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
A deal is going to be made with China. Nothing's over yet.
There's been a lot of confusion up to now.
A 90-day pause is not an eradication.
Where is this leading to?
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
It's your Bloomberg Brief. I'm Danny Berger in New York. Let's take a look at what's on the front pages across papers this morning. The New York Times has this, that the Trump administration's move to freeze $2.2 billion in multi-year grants to Harvard after the school refused to agree to a list of government demands. Those included reforming Harvard's governance, ending diversity programs, and changing admission and hiring practices. Next up, the Wall Street Journal has this, that the president of El Salvador says that he didn't have the authority to bring back a migrant who was deported in error. This raises the legal stakes days after the Supreme Court ordered the U.S. to facilitate his return. Attorney General Pam Bondi said that it was up to El Salvador to return the person, not the U.S. Quickly on the FT, diamond traders are warning that the $82 billion industry has ground to a halt because of U.S. tariffs. Diamonds are now subject to 10% import duties on so-called retaliatory tariffs. Okay, more on these markets coming up next.
Literacy is a big problem in the United States. I think 14% of adults are functionally illiterate, which means they can't read past the 4th grade level. That's a large percentage of the population. Nothing the Library of Congress can do can completely solve that problem, but are you surprised at how many people still cannot read in this country and how many people have another problem called illiteracy or illiteracy, which means they can read, but they don't choose to read?
It's a challenge with the digital age because people they're reading on tablets, so we do count that as reading. If you have an e-book, you're reading the book, and I've been often asked if I'm listening to a book, are you reading? Does that count? But there is a concern that the amount of reading, actual text that people are doing, is diminishing. And so how do you work with other organizations? So the Library of Congress connects to public libraries, school libraries, and we do joint programming with them.
Why do we actually have all these thousands of libraries anymore when people are often doing things digitally and they don't need to go to a physical place to get a book?
People are using public libraries as, and someone has said, as opportunity centers. And libraries are offering collections that are beyond books. So libraries are circulating and responding to communities in so many ways.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. More tariffs coming soon. The Trump administration initiates probes on pharma and chips. But a possible break for autos, President Trump considers pausing his car maker tariffs, giving them more time to set up in the U.S. And a trader's paradise city in Bank of America report results as the big banks bring in a record equity trading haul. Well, we finally got 2 days of back-to-back gains for the first time since Liberation Day. We try to add to that today. NASDAQ 100 outperforms up 0.4%, trading the positive mood music of tariffs, a delay to autos, but we are looking at extremely negative sentiment from the most recent Bank of America survey. We'll get into that in just a moment. When it comes to this bond market, also a lot of relief there too. You saw 10-year yields drop by 11 basis points yesterday. We are lower by about 1 basis point this morning, 4.3%. By the way, the short end seemingly outperforming yesterday after Governor Chris Waller saying that we might get something that looks like front-loading rate cuts and that inflation would be a one-off with tariffs, but we sell off this morning only by a basis point. We're higher on the front end of the curve. So when it comes to tariffs, President Trump says that chips and drugs could be next in line for sectoral tariffs. Stocks in both sectors are on the move this morning, but a lot of volatility there as we try to assess it. Auto shares also trading unevenly. GM down 1.2%, while Ford's up 0.5%. President Donald Trump said that he was exploring possible temporary tariff exemptions on imported vehicle parts.
I'm looking at something to help some of the car companies where they're switching to parts that were made in Canada, Mexico, and other places, and they need a little bit of time because they're going to make them here, but they need a little bit of time. So I'm talking about things like that.
For more, let's bring back Bloomberg senior editor Bill Ferries. Bill, great to see you again. Can you just illuminate us where we stand on sectoral tariffs to come?
Well, President Trump made some interesting comments yesterday. He said, I don't change my mind, but I'm flexible. And so he seems to be showing some of that flexibility when he talks about perhaps giving a reprieve to auto companies in terms of auto imports and auto part imports, where they source those and how long they have to produce those within the United States. But we don't have any details on that so far. What we have seen over the last week or so is really his focus going from these country-by-country tariffs to more of a sectoral focus. He's started a Commerce Department investigation into the pharmaceutical industry and the chip and chip manufacturing industry in terms of what they are importing into the U.S. That sets a 270-day clock ticking. I would expect we'd get something much sooner than that that would likely result in recommendations to the president for some sort of specific tariffs on those kind of imports.
The clock is also still ticking down when it comes to this 90-day pause for tariffs, for tariffs on countries specific. NEC Director Kevin Hassett saying that they've gotten at least 10 very, very good, amazing deals, I believe were his words, Bill. Do we understand what these very, very good, amazing deals might be?
Well, and I think Peter Navarro said he's looking for 90 deals in 90 days. So we're several days into that. We know that some of the countries that the administration says are at the top of the list for an agreement, that includes places like Japan, South Korea, Argentina, where Treasury Secretary Scott Bessent was just visiting. And we know that the White House has signaled that these deals might be about a lot more than tariffs. They might have a little bit on the tariff front or the non-tariff front, but they could also include foreign governments or companies abroad investing in projects in the United States. So there's been talk about pipelines, investing in pipelines in Alaska, energy deals, and having foreign companies or governments helping invest or subsidize those. I don't think we have any kind of a cookie-cutter idea of what a deal will look like. So there's going to be a lot of focus on what perhaps Japan gets in this, if they are indeed, as Bessent has said, basically at the top of the list. And Scott Bessent also saying that whoever makes the first deal is likely to get the best deal. So there's been a real scramble by countries to kind of get their negotiators in and start talking.
Bill, really appreciate your work this morning. Thank you so much. Bloomberg's Bill Ferry's there. Well, with the volatility that some of these negotiations have spurred, the latest Bank of America Global Fund Manager survey showed a record number of investors intend to cut holdings in U.S. equities. Data from them also showed the largest two-month drop in equity allocation. Amy Wu Silverman, head of derivative strategy at RBC Capital Markets, noting the same turn in sentiment, writing that the best word to describe investors is shell-shocked. Overall, I have not really seen anyone other than retail express the sentiment that it is time to buy the dip. Pleased to say that Amy joins us now. Amy, the sentiment is so bad, but I gotta say, we're now only off, what, 12% from the highs, only down 8% for the year. Given what you're describing and what the surveys are describing, you would think we'd be in the midst of a bear market. Is there a mismatch between what people are saying and what they're doing?
Yeah, it's a good question. And I think a little bit of it comes down to the fact that people came into this environment, you know, overly long positioned, but they were sort of well hedged. And I think the question right now is, what does the down the road look like? What do earnings look like? A lot of investors I've spoken to these last few weeks have felt okay with the drawdowns because they were well hedged, but then those hedges got monetized. And the question from here, Danny, is do we reload those hedges, or do we think that this is the bottom? And I think a lot of investors have not come to a decision on that yet.
That's interesting. So it's a lot of sideline and waiting. So Amy, is it earnings season as you're laying out that will get us to make that decision, or is it continued headline volatility on policy? What's more important at this point?
Yeah, I think it's actually going to be this kind of intermingling between the two. I think it's going to be when management teams actually come out and investors get to ask them, hey, look, like these are the headline risks. What are you doing about it? How have you been managing your inventory? What are you going to give us in terms of guidance? I've had a lot of investors tell me, you know, they're worried about this idea of companies just pulling guidance and they're just not sure what to model. You know, it's almost in some cases better to have a worst case scenario than to have a, you know, a question mark scenario, because then you can price in all sorts of your own tails in effect to not having that guidance. And obviously we have seen a lot of companies pull their guidance, and we're pretty early into earnings season as it is.
We are early, but the signals we've gotten so far do feel mixed, Amy. You have someone like a Walmart saying that they're not going to push prices higher because of their value-oriented customer. You have others saying that the math doesn't work and we need to, LVMH being the most recent of it. What are investors preparing for if we do get a very mixed set of results or pulled guidance? Amy, to your point, you can't really model that in. So how complicated does this earnings season get?
Yeah, it's getting very complicated, and I would say there's obviously going to be this sectoral differentiation. You know, some companies are going to fare better and others aren't. It just depends on their exposure to international revenue, probably in particular to China. You're kind of seeing this modeled out in the single stock volatility, and I do think that'll get more disparate. So obviously, you know, right now we've had the financials kind of kick off earnings, and they've actually been okay, but we haven't gotten to the nitty-gritty of the companies that I think the bulk of investors are starting to fear. You're going to get kind of late week 6 retail earnings, and, you know, perhaps Walmart as one of the bigger players has been okay in what they have been signaling, but not necessarily the others. And so we do see a lot of activity, again, going back to those hedges, that I think investors could reload in some of the related ETFs like an XLY, an XRT, or an XLP.
So, I mean, if some of the sell-off we saw was structural to where we started, this idea that we came into the year very long, or you could even point to the Treasury market where the consensus seems to be that maybe that was more structural too, with things like the basis trade and leverage trades forcing that hand. Have we cleaned the decks, or are there still vulnerabilities in the system right now if we do get more concerns in terms of tariffs, in terms of earnings, that could reignite some of these fears?
I'd say yes, definitely. In terms of, you know, where the bones are buried, so to speak, you know, if we continue to get these violent moves in treasuries or equity, I mean, it doesn't necessarily matter, Danny, at this point where it's coming from, but I do think that we're still not prepared for that ultra left tail, or frankly, that ultra right tail. And I think it is that worry that has caused you to have sort of this reflated volatility regime. So yes, obviously VIX has come down. And I actually thought it was super interesting yesterday during Bloomberg's interview with Scott Bessent that he actually called that the VIX spike was over. He actually said that in his interview, like as a derivative strategist, my ears perked up. But I don't know that that's necessarily the case, because we've just kind of gotten into a higher volatility regime, and we might just sit there so long as we don't know what's going to happen with negotiations as we kind of hit this pause button right now.
I think the Treasury Secretary might be coming for your job, Amy. Until then, so great to have you on. Amy Wu Silverman of RBC Capital Markets. Okay, coming up, the last of Wall Street's big banks report. Citi and Bank of America are on deck. Stephen Bigger of Argus takes us through the numbers and what he's expecting. This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the hardest part of being a CFO?
It's hard to come up with that.
It's the vast responsibilities, the need to be engaged in different topics.
It's remembering which audience I'm speaking to and what I can say in that context.
The job is not just being the executive of the finance function, it's being an executive for the company.
I would say it's prioritization.
Complete the sentence. The hardest part of being the CFO is?
Telling people no. It's hard. It's the right thing to do, but it's always hard.
So being just like a touch of a heartbreaker, basically.
Yeah.
We have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
New episode premieres April 23rd, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Markets will likely continue to be volatile until we have further clarity. The administration's focus on trade barriers and strengthening the U.S. competitive position is commendable. At the same time, it is important to recognize that few companies have benefited more from the post-World War II economic and financial order than the U.S.
Goldman Sachs CEO David Solomon talking on volatility, which, let's be honest, has been paying off for the banks so far. Bank of America and Citi will be rounding out Wall Street bank earnings for the quarter. Shares little change for some of those banks this morning. Joining us now is Stephen Bigger, head of financial institutions research at Argus. Stephen, great to see you this morning. So the banks we've heard from so far, it is like record after record of equity haul, 12 billion altogether. What do you make of those numbers and the figures we've heard from the banks?
Yes, good morning. The trading environment has certainly been favorable for banks in the first quarter. And it's not just for equities, which had a fantastic quarter, but of course, fixed income, currencies, commodities, that volatility has, banks have been able to take advantage of that, certainly. And Probably, to continue. Certainly in the early weeks of the second quarter, we're seeing more of the same. So banks do benefit, particularly when you have this major repositioning type of trades, not just kind of the steady up or the steady down as we saw for much of the first quarter. So yeah, very good environment for trading.
But the concern always comes, Stephen, is it the right type of volatility, or is it the volatility that forces clients on the sidelines, especially when it comes to things like wealth businesses? What do you understand from the post-Liberation Day type of volatility? Is that still going to be benefiting the big banks?
Well, the raw trading revenues will, but yes, I think as you allude to, the street really doesn't give too much of a market multiple for trading revenues because they are a bit fleeting and usually unsustainable at such a high level. So yes, the conversations that banks want to be having would be more the constructive type around M&A activity or IPO activity, and that is largely put on hold because of the tariff talks and companies just taking a pause and not knowing what the next quarter or two is going to bring. So. The first quarter was not terribly bad on that front. We did see a little bit of activity more early in the quarter, but yeah, that definitely hit the pause button by corporations, and banks are not seeing the light as yet. Anyway, we still think there could be a recovery later in the year as we get more clarity on tariff and trade policy.
Because I was going to say, Stephen, I mean, the conversation is so different than where we were at the end of last year and the start of this. It was animal spirits. It was deals coming back. It was a more friendly regulatory environment. You say we need more clarity in order for deals to come back. But we've seen for the Trump administration that some of the uncertainty has really been a feature in terms of their negotiating style. Does there come a period where M&A, IPOs, we just get ahead of it? Or how necessary and what type of clarity do we need for it to happen?
Yes, well, you're right. Certainly the narrative coming into the year was much more positive. You had the notion of deregulation for the banks on a couple of fronts, and not just on the activity for M&A and maybe having an easier time to get deals approved through the Federal Trade Commission or the Justice Department approvals and the like. So there was a pretty strong head of steam coming in. That just hasn't really worked out, so far anyway, because of it's been overshadowed by trade policy. So, what corporates tend to need, there's a combination of things that tends to kind of add to deal activity, and those are good financing terms, for example, a market that's functioning well. Right now we have interest rates mostly on the upturn rather than a downturn, so that makes deals more expensive. Better stock prices. A lot of these deals are done with currency of the stock of the company. So if the stocks are down, that's also puts the deal under pressure. CEO confidence about the economy. So there's a range of things that kind of factor in, and frankly, all of which are uncertain right now or negative.
So in about an hour's time, we're going to get Bank of America earnings. About an hour after that, we'll get Citi. Stephen, what are you expecting from them this morning?
Well, we had a pretty good read-through, and the banks have been pretty consistent. J.P. Morgan, Morgan Stanley, so far, Goldman Sachs yesterday. We've had, we certainly expect that great trading environment. Now, if you look at the lending side, that's actually held up okay. We expected pretty weak loan growth with higher interest rates coming into the quarter. That's what we got. A little bit of net interest margin pressure because of the higher interest rates. Because of the lower interest rates coming into the quarter, but the good news is on credit quality, right? They've had very good, the ability of these companies to look ahead and try to get a handle on credit costs has been noteworthy, and I think that's we're going to see more of the same for that. And I will say that some of the more recent data from the Federal Reserve on 60, 90-day delinquencies on credit cards, auto lending, areas like that have been pretty weak. So it is noteworthy that the banks are able to have a good credit cost environment. I think most have kind of built up reserves going into the quarter of say a 5 to 5.5% unemployment rate. We're at 4.2, so they've got a pretty decent cushion in there, and don't see that type of big slowdown at least in the jobs picture, looking ahead a few quarters.
Well, we'll see what this morning brings. Stephen, thank you so much. Stephen Bigger, Head of Financial Institutions Research at Argus. Again, we're going to hear from Bank of America, 6:45 or thereabouts a.m. New York time, and Citi comes about an hour after that. Some more earnings to work through. LVMH has lost the top spot as France's most valuable company. Hermès market cap has now surpassed Bernard Arnault's LVMH. That comes after LVMH released disappointing first quarter results. Joining us now is Bloomberg opinion columnist Andrea Felsted. Andrea, changing of the guards, what was so disappointing at LVMH?
It was really every division missed expectations. There was no growth in each one. The impact from tariffs was pretty limited so far, but obviously it's very early days. All the interest was on the American consumer. And LVMH said that when it came to fashion and leather goods and watches and jewellery, American demand actually held up. Now, what was interesting was Sephora slowed compared to a year ago, and also wines and spirits really struggled. So those last two, beauty, cognac, they may have been impacted by tariff worries.
It's so interesting that beauty and Sephora did poorly, Andrea. I just wonder what you make of that change, because this is a segment that not just for LVMH, but across retailers had been really strong. Something changed with consumer sentiment, consumer preferences there?
There was a comparison with a year ago when it was growing very strongly. So you had a year-on-year effect. But we have seen a bit of a slowdown in the beauty market. Don't forget, beauty's been on a tear for the last 5 years. We've all bought skincare. We've all bought makeup. Hair's been a massive growth. We talk about the skinification of hair. We all put 5 products on our hair now rather than 1. When times are tough, that's just the sort of thing, you know, people might cut back on.
Yeah, I mean, I've seen crazy videos of like hair oiling, which I like don't even understand what it is. Yeah, no, it's spot on. We need like a 6-step routine for our heads now. Andrew, before we let you go, and we could talk about hair routines all day, I want to ask you about manufacturing from LVMH, because we have the CFO speaking about it, saying that there was capacity to increase manufacturing in the U.S. But of course, Andrew, these are the types of things that take years and take labor and take experts. How realistic would it be for someone like an LVMH to shift some of their manufacturing into America?
I think it's going to be quite limited. You know, these companies, you know, trade on their European heritage. Most of the supply chain is in Europe. Saying that, LVMH has made a go of production in the US. It's some handbags, some small leather goods. It's possible it could definitely do more of that, but there will, you know, we'll not only have to buy the plants, it will have to train the workers, and perhaps that is the most difficult part of this, getting, you know, employees up to speed with, you know, sewing, construction. It's not the thing that young people want to do. So that's going to be the biggest challenge.
We're all too busy playing with our hair to get to learn how to sew a bag. Andrea, thank you so much. Bloomberg opinion columnist Andrea Felsted. Okay, coming up, we're going to set up the day for you. More Fed speak. And I hope you've done your taxes. It's the U.S. tax deadline. This is Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily. Only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Let's get you set up for your trading day on this Tuesday. Bank of America and Citi will be wrapping up the big bank earnings. Those numbers are out before the bell. Plus, the U.S. income tax deadline is today. And Fed Governor Lisa Cook will be speaking at 7 p.m. Eastern. Let's look at some stocks on the move pre-market. China has ordered its airlines not to take any further deliveries of Boeing jets, part of the tit-for-tat trade war. You can see the impact there. Boeing down more than 3.5%. General Motors also falling down 1.2%. Despite some relief, maybe temporary reprieve for tariffs, Barclays downgrading GM to equal weight from overweight, cutting its view on the U.S. autos industry and mobility to negative. Finally, we're looking at Citi. It is trading higher ahead of its earnings results pre-market, up 0.7%. Will it be another bonanza when it comes to the equity traders? All right, as we head to the end of the hour, let me give you a look of overall markets because we are looking at yields so far this morning. On your 10-year yield, little change. We did see the front end of the curve go lower by about 11 basis points after hearing from Fed Governor Christopher Waller saying that the inflation boost from tariffs would be temporary and concerns about the economy were more important. Okay, that's it for your Bloomberg Brief. Surveillance, that's ahead.
We're micro investors. So as micro investors looking to invest capital, whether it's in private equity or in direct lending, what we're looking for are opportunities to deploy capital at attractive risk return. When we wake up in the morning, we don't seek to avoid risk. We seek to price it correctly. And so in an environment like this, for sure, if you're looking at a portfolio company opportunity, when you think of the value creation plan, you're factoring in now the uncertainty, which undoubtedly will impact the extent to which you're willing to pay for that asset. Now, in our existing companies, in our existing portfolio, the vast majority are services company. And services companies don't have basically the input issues. But I will say that when we look and we roll up all this data for all of our portfolio companies, and it's quite rich. It's just down now below 1 million employees globally around the world. We're 2,300 at Carlyle itself, but in our portfolio companies, we roll up this data every month. For example, the inventory component of PMI was up about 4 points. I know that's not really news that anybody probably would have focused on, but we could see that happening months ago. So immediately, when it looked like the new administration was going to come in and there was the possibility of tariffs, you could see purchasing managers immediately mobilizing to start bringing goods in faster because of the uncertainty factor.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
I did not like all the mixed messaging we got on tariffs over the weekend.
We are getting some certainty. I just think markets haven't been liking the certainty that we're getting.
The more that Donald Trump seems to double down, the more investors think this is an unsustainable path forward.
It's not a sustainable situation.
If we continue along this current path of uncertainty, where objectives are not stated, it's going to continue to maintain, I think, an unhealthy level of volatility for the markets.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Tuesday, looking for a third day of gains as the president considers more exemptions.
I'm looking at something to help some of the car companies where they're switching to parts that were made in Canada, Mexico, and other places, and they need a little bit of time because they're going to make them here, but they need a little bit of time. So I'm talking about things like that.
The White House offering some support after policy volatility shakes up global markets. The Treasury Secretary downplaying the recent sell-off.
Even the president recently remarked that the bond market was, quote, queasy. Do you have a sense of who is dumping U.S. assets? Who's been dumping U.S. treasuries?
I don't think there's a dumping, and I think we saw in the tick data either today or Friday that actually foreign ownerships picked up. I think a lot of people got very leveraged, maybe out over their skis.
So you don't think it's sovereigns, potentially it's hedge funds unwinding?
I have no evidence.
The Treasury Secretary, Scott Bessent, helping to put a floor under fragile bond market confidence as questions continue to linger over U.S. assets. The latest fund manager survey from Bank of America showing 73% of respondents say U.S. exceptionalism has peaked, and a record number of investors intend to cut U.S. stocks. The dollar struggling to avoid a 6-day losing streak.
What is interesting is you are getting a bit into treasuries. If you want some comfort, that is the place to have comfort. The other bit of comfort is that Bank of America fund manager survey that you cited really does highlight how much the contrarian trade now is to go into U.S. assets. Look, it is important to remember that we just saw, yes, the first back-to-back gains in the S&P going back to April 2nd, but we were only 10% below or 12% below the mid-February peak. So, yes, we have seen a pretty big drawdown. At the same time, it's not the catastrophic bear market types of feelings that we had maybe, I don't know, 2 days ago.
The survey's pretty phenomenal from Bank of America. Just to go through those headlines, if you are just joining us, welcome. The 5th most bearish in the past 25 years. The 4th highest recession expectations of the past 20 years. And the outlook for the US dollar and profits, the worst since 2006, 2007. Lisa, is it that bad right now? Is it that bad?
All of the soft data seems to confirm this type of sentiment. We have seen that in the University of Michigan Sentiment Survey. We have seen that when it comes to even the AAII investment sentiment surveys. We have seen this feeling that there is a regime change that you cannot see. That said, the hard data continues to be strong. We get bank earnings, the commentary from all of the bank executives. We're not as worried, at least about ourselves. We could see deterioration. So at what point do these things add up? Does the uncertainty that nobody likes translate into actions that investors really don't like?
So it's not shown up in a material way in the bank earnings, and we'll hear from Bank of America later this hour. We talked about this yesterday. Goldman raised the buyback up to $40 billion. That's a display of confidence. JP Morgan raised their outlook. That's a display of confidence. Can United Airlines do the same thing a little bit later when we get earnings from them?
A bit of a different story. Certainly we saw from Delta a bit of a different story, although you could still get share buybacks if they believe that they are undervalued. They are expected to sort of underperform some of the expectations. But at this point, that is a good question. How much strength do they have given the resilience that you have seen in the consumer so far based on trying to gird for what's ahead, which is an expectation of a real big slowdown, particularly among domestic travel?
Just a little bit of stability at the moment in the equity market. Equity futures so far positive by, let's call it, 0.2%. Coming up on the programme, we'll catch up with Christian Muller-Glissman of Goldman Sachs with stocks on a two-day winning streak. Terry Haynes of Pangea Policy as Trump offers autos some support, and Ken Leon of CFRA reacting to earnings from Bank of America. We begin this hour with stocks higher as President Donald Trump floats a potential auto tariff pause. Christian Muller-Glissman of Goldman Sachs writing, we remain defensive tactically as markets continue to reprice recession risk near term, but we are shifting more neutral across assets for 12-month horizons. Christian joins us now for more. Christian, welcome to the programme, sir. Let's just go through these headlines that we got from the fund manager survey from Bank of America. Super bearish. The fifth most bearish in the past 25 years. Do you think things are that bad right now?
No, not really. I think to some extent there's a lot of bad sentiment, and that's helped the market recover. I think last week, at the beginning of the week, our risk appetite indicator went intraday on Monday to -2. I mean, that's extreme bearishness, that's very sharp moves, and that was a lot related to this uncertainty around tariffs. But I think since then, I think there's been a decent amount of relaxation. And if you actually look at like risk pricing across assets, I don't actually think there's that much bearishness in markets right now.
Christian, do you think there should be? Do you think we should be pricing in a deterioration in the economic data? Are you anticipating that in weeks and months to come?
Yeah, I think the challenge is like there's always three cycles we try to understand: the sentiment cycle, the business cycle, the structural cycle. So the sentiment cycle was incredibly bearish at the beginning of the week last week, and I think that kind of created this temporary rally because you had like peak tariff uncertainty, at least in the investors' minds. But the challenge is we still need to deal with the business cycle, and we need to deal with the structural cycle. The business cycle is deteriorating. According to our economists, you're going to have weaker growth kind of to the extent that recession risk is still 45% in the US. You're kind of close to zero in terms of growth and well below trend. So you need to rebuild risk premium for that. But also you have that inflationary element of the tariffs, which might constrain the central bank put. You see the longer-dated bonds not buffering for all kinds of reasons. So I think the business cycle to us is still quite challenging. And then you mentioned it earlier, there's the structural cycle concern about US exceptionalism. And I think the market is currently making a major potential reassessment of valuations of US assets. So both those things make us a bit concerned about the kind of near-term picture on risk assets.
You said that for the sentiment cycle, we reached peak tariff uncertainty in the past week. What makes you so certain that we've reached peak uncertainty and we've passed that point?
No, I think this is what the market is hoping to some extent. You had like this incredible uncertainty coming out of the weekend going into Monday with the enormous volatility you saw then. And since then, I think the tariff news flow has been a bit more specific, a bit more de-escalatory. And to some extent, the way markets work, obviously, is always the first time you have a shock, it's the worst. The second time you have the same shock, it gets less bad. So I think the speed on uncertainty sell-offs related to tariffs might come down from here because you already kind of had a major shock and it's being de-escalated. But also now we're starting to understand those shocks a bit better. So I would say like the tariff uncertainty might not be as big of a driver of sentiment as the actual data. I think now the business cycle, growth, inflation, policy, and to some extent the structural cycle will probably take over as a driver of sentiment.
So Christian, this brings me to why you see the structural and the business cycle issues as being less bad than the market might be pricing in. The fact that you moved from defensive to neutral over the past couple of days, even with some of these hanging concerns with respect to U.S. exceptionalism, with respect to the potential souring in the economy.
Yeah, I think the important thing is the baseline is that we don't get a deep, lasting recession in the U.S. So from that perspective, you've had a decent drawdown, and we shifted essentially a bit more neutral after that drawdown, if that makes sense. So for medium-term investors, you have to consider, do you actually expect a deep, cyclical bear market or possibly even a structural bear market. And if not, you might want to use those opportunities to dollar cost average. And while we're neutral with regards to the broad asset complex, we're overweight cash to kind of moderate to some extent risk, because in a stagflation type backdrop, the equity bond diversification doesn't work. So we don't want to necessarily carry on this very risk off allocation which we currently have, which is overweight bonds and underweight equities over the 12-month horizon. I would agree though, you have to be careful about structural losers. So when you think about like the 12-month horizon, the structural cycle will potentially matter. And if we do see corporate profitability in the US, especially for these large cap capital light business models, start to come down, you want to avoid those areas, the most highly priced areas of the market, when you start to think about re-risking.
Christian, are you talking about big tech?
Well, yeah, I think we have to be completely honest. It's been 15 years where big tech and large cap capital-light business models have driven up U.S. equities, U.S. equity valuations because of rising corporate profitability. We wrote about this in our research. The combination of low and anchored inflation coupled with rising return on equity can explain a lot of the valuation advantage that U.S. equities have versus the rest of the world, but also relative to their own history. So if you now see the tariffs push up inflation and weigh on corporate profitability for those capital-light business models, I think you have a bit of risk that valuations are coming down a bit.
Could you explain the kind of equity exposure that you are comfortable taking and where it might be?
Yeah, I think like right now we're definitely focused on international diversification. It's a big topic. Like you have to be careful, of course. You always wonder like where would you want to go, if not the US, after 15 years of that outperformance. So we're very focused on obviously themes like infrastructure, real estate, real assets that potentially can do better in the world of stagflation. And compared to 2022, when infrastructure and real estate actually didn't do that well because of the aggressive Fed tightening and these places being a bit more levered, maybe that risk is a bit lower. So these areas could actually do a bit better, a bit more value-ish. And the other area is low volatility as a style. We've been very focused on low volatility across the regions as a way to potentially introduce safety in the portfolio when the bond market doesn't buffer as well as it did, for example, in 2024 when you had the growth scare.
That raises a question, Christian. In a stagflationary environment, does 60-40 die?
I think die is a bit strong, and I would certainly argue that starting point matters. Like in 2022, US 10-year yields were at 1.5% and they went above 4%. I think if you look at current US 10-year yields, they're in a much better spot to kind of, to some extent, not have that negative convexity which you had in 2022. And I think unless you really see inflation go up like in the 70s, where you went to 10%, I think like you're in a very different spot. Like our economists expect core PCE inflation to go to the mid-3s and then linger there a bit and then come down, considering that the tariff shock theoretically should be a bit like a one-off. I think we're dealing with a much softer form of stagflation where 60-40 would not necessarily be as badly impacted as in 2022. But I would certainly argue that it won't work as well as we are accustomed to as a generation of investors. What I would say, though, is that international bond diversification can work. And if you actually look in the last 2-3 weeks, like German 10-year bonds, even Japanese 10-year bonds, they did a better job than treasuries in buffering equities. So you can do things to make the 60-40 portfolio work a bit better by going international in terms of diversification.
Christian, appreciate your time, sir. As always, Christian Muller-Glissman there of Goldman Sachs out of London this morning. The #1 crowded trade in the Bank of America Fund Manager Survey, long gold. Speaks to the question that you're asking.
How do you diversify? We also have heard this incredible diversification outside of the U.S. into other markets. I just want to say this. There's a little bit of out of the fire into the frying pan with this, because if you think about Germany and Japan, they both are engaging in potential fiscal stimuluses that could potentially pressure their bond markets too. So it isn't such a clear picture, and I'm smiling because there is this question of what diversification means when it's not a stagnant picture. These companies, these countries are all taking moves of their own.
We've had a few days of stability in the bond market. Let's hope it continues. It's going to take a number of days, weeks and months to really put to bed the idea that we're questioning the safe haven status of the United States. But Anne-Marie's interview with Secretary Besson yesterday, I think, goes to some way to express where the Treasury Secretary's at the moment and how he considered the moves of the past week or so.
It sounds like he looks at this as really leveraged trade unwinds or just something that's more technical. He says that he's looking at tick data. It is backward-looking, just to point that out, in terms of foreign investor demand. But we heard that from Bob Michael also of J.P. Morgan Asset Management. It is more than a couple days that will remove this theme that U.S. Treasuries can be a haven.
Bond yields higher by just a single basis point this morning, just short of 440 on a 10-year. With an update on stories elsewhere, with your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. The Trump administration announced that it launched probes into semiconductor and pharmaceutical imports earlier this month. It's a move that could lead to new tariffs on the sectors. The probe, being led by the Commerce Department, is investigating the impact of the imports on U.S. national security. Elsewhere, China has ordered its airlines to stop taking deliveries of Boeing jets. Sources tell us that Beijing also asked carriers to halt purchases of aircraft-related equipment and parts from U.S. companies. The Chinese government is also considering ways to assist airlines that lease Boeing jets and facing higher costs. Hermes briefly surpassing rival LVMH in market cap, making it the third largest company in Europe as LVMH saw disappointing China and U.S. sales. The move indicating the still independent luxury brand as it weathers a recent downturn in luxury demand and after it shunned an LVMH takeover over a decade ago. And that's your brief, John.
Danny, thank you. Those numbers not great. Down 3% in the US, Lisa, down 11% in China. The only bright spot was actually Europe.
So this raises a question, is it luxury or is it loud fashion? Is it a misstep in terms of planning, which I'm sure Anne-Marie and yourself could probably tell me more than I really could give insight on, but there is this larger question of the Chinese exposure that a lot of these luxury brands have.
I'll let Anne-Marie address that when she gets back tomorrow. Up next on the program, the president considering some relief.
I'm looking at something to help some of the car companies where they're switching to parts that were made in Canada, Mexico, and other places, and they need a little bit of time.
We'll get you the latest down in Washington, D.C. in just a moment. We'll catch up with Terry Haynes of Pangea, live from New York City this morning. Good morning.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Equity futures just about positive. The first two-day winning streak on the S&P since April 2nd, Liberation Day. Just put that together in yesterday's session. Can we make it day three? Up by 0.2% on the S&P. On the Nasdaq 100, up by a little more than 0.25%. Under surveillance this morning, the president considering some relief.
I'm looking at something to help some of the car companies where they're switching to parts that were made in Canada, Mexico, and other places, and they need a little bit of time because they're going to make them here, but they need a little bit of time. So I'm talking about things like that.
So here's the latest this morning. The Trump administration mulling possible temporary exemptions for automakers, buying time for companies to bring manufacturing back to the United States. Bloomberg's Tyler Kendall joins us now for more. Tyler, welcome to the program. At the same time they're considering offering support, they're also considering more tariffs. Is that right?
Yes, John, good morning. Well, more tariffs, particularly when it comes to some of these other sectors, including pharmaceuticals as well as semiconductors. This administration has formally launched a Section 232 investigation, which would then very likely result in tariffs being implemented on the basis of national security concerns. And we should say that these probes are actually rather large. They include pharmaceuticals, but also the ingredients that go into pharmaceuticals, as well as those chips, but also the equipment that's used to make chips, as well as those downstream products like consumer electronics that have the chips within them. Now, when it comes to what this potentially could look like moving forward, President Trump has said that he would be open to some exemptions, particularly when it does come to those chip products that he would be looking at, but has yet to specify exactly what would be in it. That relates to what you're talking about when it comes to these potential auto tariffs, with President Trump saying that he would be looking at some sort of temporary relief for those car makers who would move auto part production to the U.S. We have to keep in mind that the auto parts have long been sort of the tricky part of the equation here because, John, the U.S. has said that we will not tariff U.S. content within the parts, but it's getting increasingly difficult to decide between what is U.S. content and non-U.S. content within auto parts because all of these supply chains are just so highly integrated.
Tyler Kendall with the latest down in Washington. Tyler, thank you. Lisa, here's the situation for me. If you're a company at the moment, you're spending more time trying to secure an exemption than you are moving a supply chain. That's probably not a great position to be in.
Well, it also suggests that there has been real confusion about what the goal is and how they can get these tariffs through and under which provisions, given the fact that they started with the bazooka, no exemptions. Remember, there were no exemptions. Then there are lots of exemptions, and now line up and get your exemptions because we recognize that there is time. Which is it? And how much does this undermine potentially their arguments about emergency action?
Terry Haynes of Pangea Policy joins us now for more. Terry, welcome to the program. The administration, I think, has done a very good job. I think President Trump's done a good job of articulating the problem for a number of years now, going back decades, the remedy to the problem and the execution of that remedy. What's your reaction to that over the past few weeks?
Well, it's been scattershot, Jonathan, frankly, and good morning, both on strategy and execution. But, you know, if there's a consistency in the Trump presidencies, I think what you can see is that what he tends to do is kind of go big, bold, clear, motivational, and then start embroidering off the exceptions and the like, and that's certainly the pattern now. You know, it's, you know, I want to be very clear about the direction we're moving in terms of, you know, what we're manufacturing, where we're manufacturing it, how we're doing it, but then you know, we're going to wait to have the industries come back and separate the wheat from the chaff on what's legitimate and what's not. So it is a difficult process for everybody. I understand that, and it's a very difficult process. And at the same time, that's how they operate.
John has asked this question many times. Who are they negotiating with? And yes, they're negotiating with themselves inside the cabinet. They're negotiating with companies. They're negotiating with countries. And they're negotiating with the market. Terry, how does that complicate understanding exactly how to get to the goals that they ultimately have laid out?
I think what they end up doing is they prioritize those overlap, but they're not completely congruent. You know, you negotiate as best you can with the individual countries involved, and again, push forward bilaterals. You know, get your best results. Move on. Get some future promises as well. Move on. The cabinet understands that at the end of the day, the president's the decision maker, and so they fold in around. And as to the rest, you know, these companies, by and large, that we're talking about today are big companies that have, among other things, pretty sophisticated lobbying operations, and they're fully engaged as well. So,
yeah. Last night, Anne-Marie talking to Treasury Secretary Scott Bessent. Scott Bessent had a message. He wanted to talk about the three-legged stool of policy, and that tariffs are one wing of that, one leg of that. And then you had deregulation, and then you had some of the tax relief and what was getting passed through Congress. Those other two legs of the stool have been called into question recently in terms of how big they can be and how much they can offset some of the concerns over the tariffs. Do you have a sense of how that's going?
Well, I have tax cuts at 80% likely to happen in the fourth quarter of calendar 2025, and I think there's a rising possibility that it happens sooner. It's not for nothing that that Trump picks July 4th as the day on the next direction on tariffs, and they'd very much like to goose Congress as fast as they possibly can to get the tax cuts in place for the third quarter as well. So. But I'm optimistic that the Congress gets this done. There's an awful lot of alignment on that. As to the numbers, what the Senate and the House are talking about is something on the order of $5 trillion in tax cuts over 10 years, without a lot of offsetting. Without a lot of pay-for offsets, and the reason for that is they've chosen, as I've been talking about for a while, this current policy baseline that allows them to do that. So, what you're going to see is a very big tax cut number coming through, I think, and I think that probably balances or more the tariff shocks.
Terry, you think they go beyond extending existing law?
I think they do in some respects, in part because that's what Trump's wanted. These tax on tips and the salt business, all kinds of things they need to do in order to get votes and get a signature into law. Number one. Number two, they're going to have to change the tax code for a variety of things, including providing additional incentives for reshoring and onshoring manufacturing. So I'd look for all that.
Terry Haynes, appreciate the input. Thank you, sir. Terry Haynes of Pangea Policy on the prospect of Liberation Day from taxes on July 4th. No, doesn't work.
I think that works. It's Happy Tax Day, just for everyone who hasn't filed yet. Today is April 15th. I am curious about how much he can get through, given the fact that right now the bond market is yippee and fearful. And how fearful and yippee will it get if you start talking about further deficit expansion like that?
Secretary Bessent wasn't yippee yesterday with Anne-Marie, that's for sure.
No.
I love the question on the Federal Reserve. The interviews are going to start later in the fall.
Yeah.
Does Chairman Powell get an interview?
That's a great question. It also signifies that they're not going to boot him from his position because they would have to be doing it for early next year. I also like the idea of an away game, that it's a home game or away game when it comes to their meetings.
I think after Governor Waller's speech yesterday, I think maybe he gets an interview.
Oh, I think he's really gunning for one, so,
yeah.
Hopefully
we'll get what he wants. We'll talk more about that in just a moment. Up next on the programme, Sonia Martin of DZ Bank as Secretary Bessent defends the dollar.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think that all these little girls and boys, I don't want to discriminate, who are now in school-going age, imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
A deal is going to be made with China. Nothing's over yet.
There's been a lot of confusion up to now.
A 90-day pause is not an eradication.
Where is this leading to?
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
2 days of gains on the S&P 500, attempted to make it day 3. Equity futures on the S&P positive by 0.2%. Moments ago, a super bearish fund manager survey from the team over at Bank of America, the 5th most bearish in the past 25 years, the 4th highest recession expectations of the past 20 years, and the outlook for both the US dollar and US profits rated the worst since 2006, 2007. More on that coming a little bit later. With 3 hours until that opening bell, let's get you some morning movers with Danny Berger. Hey, Danny.
Hey, John. One of the big movers to the downside this morning in the pre-market is Boeing after a great Bloomberg scoop from the team that China has told its airlines to stop taking Boeing deliveries. Those shares down 3.1%. You also see some of the American suppliers falling this morning because that extends also to supplies coming out of the U.S. It's an important market for Boeing. About 18% of its revenue comes from China. Now, to the upside this morning, we're looking at Netflix gaining in the pre-market session nearly 3%, 2.8%. This comes off the back of a late-in-the-day Wall Street Journal story yesterday, where sources told the Journal that Netflix had a business meeting, their annual review, last month, in which they set some really lofty targets. They want to double their revenue by 2030, and they also want to achieve a $1 trillion market cap by that point. Just to put in context, they're just below $400 billion in market cap now. Rounding things out with some earnings out moments ago, coming from J&J. Johnson & Johnson was higher when they initially reported earnings, up some 1% because it was a hefty beat across the board. We've paired some of that. Maybe it has to do with the concern about pharma tariffs to come. But the CFO speaking to Bloomberg about the investigation by the Commerce Department, saying that they think it could be a good thing. It will show that they're not a national security threat, making them immune from further tariffs. Also saying perhaps it will keep some of the cheaper generics out of the market. John.
Danny, thank you. Appreciate the update. On our radar this morning, our top story, President Donald Trump initiating probes into semiconductor and pharmaceutical imports, moving one step closer to imposing tariffs on the sectors. The investigations kicked off on April 1 and could play out over the next several months.
So how do you pair this with some of the overarching tariffs that have already been put on? Was it basically to get some sort of sense, we can get 20% right now while we figure out the sectoral tariffs? Do those then come off and the sectoral tariffs come on? How much negotiation, how much room is there for Tim Cook, for Mark Zuckerberg at a time when potentially their businesses could take a catastrophic hit?
If you'd asked me a few weeks ago, I would have said not much. And then after the events of the last week, I think there's space. There's room for them to make an effort to secure exemptions based on what we've seen over the last couple of days and what we've heard from the president directly.
So there's a Trump put. That's what a lot of people are wondering. What is the contour of that? What are the contours of that Trump put? Is it the Treasury market potential dysfunction? Is it this question around how much tech giants sell off and the idea of the U.S. possibly losing some of its dominance to China should some of these go through? That's one big question here. Where are the lines of argument that these companies can really take?
The put never went away. We just tried to figure out where the strike price was. I think we figured out over the last week. Likewise for some officials on the Federal Reserve. What's really interesting about Governor Waller, and we mentioned him a little bit earlier, he came out very early and downplayed the possibility, the potential that tariffs would lead to higher inflation and second round effects. He did that a number of weeks ago. What he did yesterday that I thought was really interesting, he didn't stick to script. The rest of the Federal Reserve has come out and pledged to anchor inflation expectations. front and center. He's come out and basically turned around and said, if we threaten economic growth, or if we threaten to go into recession, I'm going to cut and be willing to cut much more. Now, he's differentiating himself from the rest of the committee. I'm not going to sit here and say he's running and he's going to be the next Federal Reserve chair, but I think that's certainly an attractive option for this White House right now if they were looking at potential candidates on the FOMC.
He took the framing away from the dual mandate of inflation versus unemployment, and the other Fed officials talked about how inflation was number one, and then they could talk about stabilizing employment. He called the new tariff policy, Chris Waller, one of the biggest shocks to affect the U.S. economy in many decades, and said the future of that policy, as well as its possible effects, is still highly uncertain. This makes outlook also highly uncertain and demands that policymakers remain flexible in considering a wide range of outcomes. Is he speaking to some of his colleagues, or is he speaking to the market?
Who knows? Is he speaking to the White House?
Exactly.
We'll find out. Secretary Bessent talked about interviews taking place later this fall, and we'll see if Governor Waller gets one. China, this is how they're responding. Ordering its airlines not to take any more deliveries of Boeing jets. Sources telling us here at Bloomberg that Beijing has also asked carriers to hold any purchases of aircraft-related equipment and parts from U.S. companies.
So the idea of escalation, have we really taken that off the table, or is escalation going to look much more targeted, much more deliberate, coming from China, putting pressure on specific executives to go to Washington, D.C. and lobby President Trump for possible exemptions? How much is this the long game for China at a time when they aren't going to necessarily escalate with just simply raising tariffs that much higher? Look, it is so hard to track every morning where we are in this tariff whack-a-mole. You know, you smack one down, another one pops up over there, and that's kind of, you know, different elements of this trade war have been ongoing.
Based on the estimates I've seen, effective tariff rates are now at triple digits on both sides of that trade relationship between the US and China. So what's left? What's left is stuff like this. You basically just tell companies to stop buying, full stop.
What's the goal, though? Because from China's perspective, this is a significant part of their jet supply. So is the end goal to ratchet up the pressure on specific people who might get an audience with the president? That seemed to be what the Europeans were trying to do with going after particular Republican states and the economies there. So is that the modus operandi of China right now?
Let's talk about some European companies as well, Lisa. Hermes, if you look over in Europe today, briefly surpassing LVMH in market cap, making it the most valuable company on the CAC 40 index and the third largest listed company over in Europe. This coming after LVMH delivered some very disappointing results overnight on slowing demand in both the United States and in China.
What's been interesting is how much Hermes has been the outlier. Evidently, scarves never go out of fashion, and and Hermes has benefited from a more timeless look that hasn't gone out of style. I wonder how much signal we can take about the wealthier investor, the wealthier consumer, and how much they actually are retrenching, how much Chinese consumers are retrenching, or whether it's a winner-take-all kind of moment, where suddenly the strongest players across the board are going to be the ones consolidating their market share, or is it an element of both?
That's my question for United Airlines later. Long haul and premium, is it holding up? Because that's what's been holding up this economy now for quite a while. The upper income workers in the United States, the low income workers have been squeezed for years. They haven't enjoyed this cycle at all. We've seen that in survey after survey consistently. It predates this administration. We saw it throughout the Biden first term. And I just wonder if that starts to show up in the earnings a little bit later.
Big question, considering how much that's driven the cycle. And for people who say, take out your tiny violin and start playing it for the wealthy consumers and whether they're actually pulling back on spending, it's not about that. It's not about feeling bad for people. This is about questioning the pillars of consumer support for a U.S. economy and questioning what that means in terms of how long that can continue to power all growth.
Earnings from United coming after the bell later on. Let's talk about foreign exchange. The dollar struggling to avoid a 6-day losing streak. The U.S. Treasury Secretary Scott Bessent pushing back against any concerns.
You're not concerned at this moment about the U.S. dollar or the U.S. Treasury losing safe haven asset?
No, we are still a global reserve currency. We have a strong dollar policy. If you go and look back at President Trump's first term, I don't remember the exact number, but the dollar in 2017 went down, and then once the tax bill was done, took off.
Over the last week, the US dollar under pressure amid shifting tariff policy, briefly falling to a 6-month low early this week. Sonia Martin of DZ Bank joins us now for more. Sonia, welcome to the program. Let's just talk about what's driving the dollar weakness over the past several months. What's behind it? What are the #1 pillars of that trade at the moment?
I actually think that the narrative has changed a bit if we look back. So it really started off with the realization that Trump was going to make good on his promises to introduce harsh tariffs almost right away. So that dampened, economic sentiment, that raised fears in March of a Trump session. More rate cuts were being priced in from the Fed, and that drove the dollar lower initially. I do think that the latest bout of dollar selling that we have seen has a bit of a different flavor to it, and I would say that for the first time in a very long time, the safe haven status of the US dollar is actually under threat. I think, we have seen this before that people talk about it, but my feeling very much is that it has never been quite as serious as it is right now, and this really shows in the market reaction. We had a bit of a pushback or take back on tariffs recently. It has calmed the market down, but we haven't seen the dollar rally as a response in a relief rally, which one might have expected otherwise. And I think that really goes to show how much damage has been done in recent weeks here.
Sonia, what technicals are you looking at to give you a sense that this is real, the idea of the erosion of the dollar as having a haven status?
Well, I think, first of all, when you look at the last few weeks, we've had some real risk-off moves, and we look at other assets, other asset classes. It was very, it was very clearly unilaterally a risk-off move. Equities down, risk-sensitive assets down. We had safe haven flows in the Japanese yen, in the Swiss franc. So in that environment, you would normally expect the dollar to rally, and it obviously didn't. It actually went down quite significantly. And also, when you look at the U.S. Treasury market, again, here you see that the Treasury yield actually went up in response to this risk aversion sentiment in the market. And both of these very much, I think, confirm that there's something afoot, something is changing.
That said, Sonia, a lot of people are arguing that this is actually a leveraged trade unwind, massively. And we've heard about some really big losses at some macro hedge funds. And there's this question of how much this is a move that has been given a narrative versus a narrative that has resulted in the move. How do you separate those two?
Normally I would be absolutely on the side of those arguing that this is more as an explanation, an ad hoc explanation for a move that we've already seen. I mean, I've always been quite vocal in saying that, all these stories about the era of the dollar coming to an end are overdone. And in the past, I absolutely believe that. But my sense right now is that it's more than that. And I mean, I don't think it's just the narrative. The problem is that there is a story behind that narrative. I mean, we're talking about Donald Trump, the president who, in his first few months of office has done many things that maybe we would have considered almost unthinkable beforehand. And I think the problem is this drives massive uncertainty. I mean, at this point, what do we want to rule out? I mean, let's take the Mar-a-Lago Accord. I mean, the idea of forcing investors in U.S. Treasuries to give up their, interest-paying bonds in favor of non-interest-bearing century bonds, that's almost ludicrous. And I think with this uncertainty and this sort of feeling of anything could happen, I think that's what's damaging the dollar and dollar sentiment right now.
So, Sonia, what is the alternative? You need a deep market with lots of liquidity, a reliable issuer with stable policy. What's the alternative?
Yeah. Well, that's the big problem. I mean, when you look back, I mean, we have this sort of codependency that's evolved over centuries, decades, sorry, not centuries, but decades. We have the U.S. depending very much on foreign capital. So the U.S. has been dependent on that source of money coming in. And on the other side of that equation, you have foreign investors who've built up massive amounts of treasuries or dollar assets. And because they're sitting on a big pile of these, it's very difficult for them to leave. So the thinking so far has been, it's too painful to leave, because let's imagine China were to announce, we're going to divest U.S. treasuries, we're going to sell out. That's going to immediately result in a massive increase in UST yields. It's going to damage the still existing portfolio China, for example, holds. So it seems a bit like a codependent situation. I think the question now becomes is what's more painful, staying in that dependency or making a hard cut. And I think that's the thinking that's driving investors to question old traditions of safe haven dollar assets.
Debates that are taking place right now in investor committees all around the world. Sonia, appreciate your time. Sonia Martin there of DZ Bank on the latest. What is the alternative? I'll tell you what the ultimate test is. If you get a bad jobs number, some bad data this week, retail sales, do bonds rally or do they sell off? That for me is going to be the ultimate test. Has it still got that haven status in times of difficulty in financial markets?
That's a fantastic test. Take it a step further. Nature is healing. with some time away from the leverage trade unwind, supposedly, if we don't get material dollar strength and if we get the ongoing sell-off in treasuries, all of a sudden you have to think maybe something else is afoot.
That would spook people, that's for sure. Equity futures at the moment just about positive, and did the bond market some stability in the last 24 hours. With an update on stories elsewhere, with your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. Several small businesses have sued President Donald Trump over his tariff policy. They argue that his use of the International Emergency Economic Powers Act is unconstitutional and that, quote, trade deficits are not an emergency. The White House responding, saying that President Trump is, quote, standing up for Main Street. Elsewhere, NVIDIA plans to produce as much as $500 billion worth of AI infrastructure in the U.S. over the next 4 years. NVIDIA started producing its advanced Blackwell chip at TSMC's new plant in Phoenix. NVIDIA is also working on key partnerships to build supercomputer plants in Texas, alongside packaging and testing operations in Arizona. And a Blue Origin rocket that sent an all-female crew to space included pop star Katy Perry, Gayle King, and Jeff Bezos' fiancée, Laura Sanchez. The flight lasted roughly 11 minutes, and Perry sang Louis Armstrong's "What a Wonderful World" as the crew looked at the Earth. This is the first time in 60 years that an all-female crew has flown to space. And that's your brief, John.
Danny, thank you. Just getting some earnings from Bank of America. So net interest income comes in at $14.44 billion. The estimate 14.36. A line that Lisa was looking for, provision for credit losses. Lisa, that comes in at $1.48 billion. The estimate 1.53.
This to me is fascinating. Provisions for credit losses. The fact that it came in lighter than expected. We saw that similar from PNC earlier this morning with provisions for credit losses also coming in lighter than expected. Where lies that downturn that everyone was talking about that the banks discussed possibly girding for?
The stock is up by 1%. It's a beat also on trading revenue. Up next on the program, the big banks embracing volatility.
Trading in all of the big firms in equities was better than expected. The banks have always pointed out to us in trading, volatility is their friend.
And apparently volatility is Bank of America's friend as well. We'll talk about those numbers in just a moment. Ken Leon of CFRA is just around the corner.
Let's cut right to it. This is Bloomberg's new show, Primer. Technology is $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on?
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
It's another beat on Wall Street. This time it's Bank of America, an upside surprise on trading revenue and net interest income. That stock is higher by 1.5% in the pre-market. Under surveillance this morning, the big banks embracing volatility.
Trading in all of the big firms in equities was better than expected. The banks have always pointed out to us in trading, volatility is their friend. Because of the volatility, they get very active in facilitating trading for their clients. And in doing so, it makes it very profitable for them.
It's certainly the friend of Bank of America this morning. Let's get you the latest and cross over to Bloomberg. Sonali Basak. Morning, Sonali.
Really clean read you're looking at Bank of America. Of course, we're seeing net interest income only not come in line with expectations. If you look through the presentation, they also held their full year expectations steady, John. If you look a little deeper, the expectation actually implies 4 interest rate cuts this year. So the question for investors become, could it actually be more than investors are currently looking for Bank of America to make this year? Coming into this print, Bank of America was trading more cheaply than the other banks barring Citigroup. So they were trading at book value. Even Wells Fargo was above this. And if you take a look, not only were the consumer businesses very clean here, as Lisa had mentioned earlier, those provisions for loan losses coming in line with expectations as well as flat from a quarter ago. So it didn't change very much. The commentary from Brian Moynihan here, very interesting, because he didn't really speak to the idea of tumult, more so just the expectation of a changing economic environment. So trying to keep the tone level set. I would also say something interesting for the people who are watching closely for the consumer loan performance. They did seem to break out the performance of the different loans differently. So you can take a look here. We know that Bank of America, the average FICO scores tend to be a lot higher than many of the smaller banks out there, but you can see how much of them are below 660 as well. And in the credit card business, that's about 12% of the book. So clearly Bank of America trying to guide folks to what the credit quality looks like underneath the hood as they keep trying to eke out more in net interest income.
The stock is higher in the pre-market by 1.5%. Sonali, stay close. We'll catch up with Sonali in about 60 minutes from now. About 70 minutes from now, you'll get the numbers from Citigroup. On credit quality, just to pick up on Sonali's thread there, Bank of America's Brian Moynihan, the CEO, saying consumers maintained a healthy credit quality. Let's get over to Ken Leon of CFRA about that. Ken, welcome to the program. What have we learned about credit quality in America in this banking season?
So I think what Brian Moynihan's going to speak about is his comfort zones, which is really Main Street, the consumer and small business. And what we saw in the release today is that credit risk committees make decisions on the current environment, not the forward environment. So that's credit. Again, the results are more stark in terms of the high volatility, the benefit for trading. Bank stocks never get rewarded in terms of multiple expansions for trading profits, but it shores up the full year. Second quarter is going to be choppy. It's really kind of like the beginning of COVID, where analysts like myself looked to the second half of this year. Is it V-shape or U-shape? We're optimistic. We think the capital markets are going to be open, but it's going to be the second half of this year. And what we're seeing is institutions and fund managers realign their portfolios. and that's good for equity trading.
Will it be a V shape? Will it be a U shape? Or will it just be a straight line? Because I don't see a dip right now. I mean, talking about the fact that you're getting healthy credit quality pretty much across the board. That's the message from Bank of America. PNC, a smaller but the biggest regional bank, came out earlier this morning talking the same kind of tone that, frankly, provisions for credit losses came in lighter than expected. Does this make you more excited for the forward look for banks?
I don't think the story is credit here. It's way too early. It's really what happens in the capital markets and what is confidence for CEOs for capital raising. So again, the second half of this year, if it's going to be stronger, it's not the worries about credit. It's really going to be what happens in the capital markets. Clearly, if there's going to be any severe recession, then it's game off, and then we can start talking with red lights for credit. CFRA, we look at every metric of every bank on delinquencies, loan loss provisions, and reserve build or reserve reverse. We're just not there yet.
Going forward, can you still get optimistic about the banks if M&A doesn't revive, but you do have credit quality that hangs in there and you have yields that are higher than previously?
So the large banks are formidable. They have, as Jamie says, fortress balance sheets. They are formidable in their industry. And we have never seen an equity market outperform without financials and banks coming along for the ride. We're overweighted in financials. We would say to you from 2007 versus 2025, when you look at the top 10 constituents of the financial sector, banks being a big part of it, they're a little less cyclical, they're more stable. And companies like Goldman Sachs with David Solomon talks about moving to more durable recurring fee revenue, whether it be in asset or wealth management or more principal investments in areas like alternatives. So the banks are very different than when we had this discussion back in 2007 or 8. And again, they're not the problem. So again, we'll see what Scott Bessent sees in the market and advises the president.
Again, there's a difference between existential risk and a recession, though. Do you really think they'd perform well in an economic downturn?
I'm sorry, I think when you look at the economic outlook, you know, again, Goldman yesterday noted that they're now still positive, but it was above 2%, 0.5%. There's also the question on duration and also just a technical definition of recession versus a recession that hurts the consumer. And President Trump will pay attention to that.
Ken, appreciate the update. Thank you, sir. Ken Leon of CFRA. I've always been frustrated with that, and no offense to Ken. This idea that you sit here and say it's not 06, 07, that doesn't mean we don't have a problem. And I think you're on the money. When people talk about V-shaped recoveries, you've got to ask the question, we haven't even had the first leg of the V. Never mind a V-shaped recovery, what kind of downturn are we going to have in the months to come? If we have a downturn, and I think that remains the question at the moment.
And what kind of downturn is it? Is it a downturn in capital markets activity, or is it a downturn in a recessionary, classic recessionary type of way, where credit losses do become the issue? Ken was talking about how credit losses are not going to be the issue. At the same time, JP Morgan, Jamie Dimon came out and said they want to be conservative. They increased their loan loss provisions because they want to get ahead of whatever could come. It is interesting to see the different approaches of the different banks trying to game that out and gird for the future.
So far, the numbers are solid, and we've seen that repeatedly across Wall Street. One more name still to come, just to wrap up earnings on Wall Street. You'll hear from Citi later on this morning. Those numbers come at about 8 a.m. Eastern time, so 1 hour and 5 minutes away. Up next on the programme, we'll catch up with Alessio De Longis of Invesco, Adam Hodge of Bully Pulpit International, Gil Luria of D.A. Davidson, and Priya Misra of JP Morgan Asset Management. Live from New York City with equity futures just about positive by 0.1%. The second hour of Bloomberg Surveillance is up next. Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
A deal is going to be made with China. Nothing's over yet.
There's been a lot of confusion up to now.
A 90-day pause is not an eradication.
Where is this leading to?
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
And Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer's customer. You know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
In terms of the hard data, it's going to soften.
What you're seeing is an economy that started from a solid baseline in wait-and-see mode, just like the Fed.
What's so unsettling right now, however, is the uncertainty of what we could see if these tariffs go through and the economy slows.
Consumers are really on their heels now. They're anticipating higher prices.
Right now, uncertainty is at an all-time high. We have volatility that is at an all-time high, and all of those factors are constraining economic activity.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning to you all. The second hour of Bloomberg Surveillance starts right now, and these are your scores. Equity futures on the S&P just about positive across the board on both the S&P 500 and on the Nasdaq 100. We've managed to string together 2 days of gains on the S&P. We haven't done that since April 2nd, Liberation Day. It has been a struggle in this equity market. If you ask the banks, it hasn't been much of a struggle at all. They've been very busy making money. Equity sales and trading revenue, it's a beat almost across the board at every single bank on Wall Street at the moment. In the pre-market at the moment, Bank of America is marginally higher by 1.8% in early trading. Bank of America this morning, revenue from equity trading rose 17%. Lisa, that's a record.
Yeah, at the same time that they also saw net interest income exceed expectations, basically in line, but a little bit higher. The interesting part about Bank of America is that they seem to be most leveraged to the consumer and to corporate health. They talk about a changing environment. That is maybe the euphemism that they use around tariffs, but they don't express concern, at least in the numbers and the projection forward, of a real deterioration in consumer experience. And that, to me, is really the ultimate question. How much of a forward look are these companies giving us with their earnings, not maybe the rhetoric?
Wrapping up earnings on Wall Street later on this morning, in about 60 minutes, we'll hear from Citigroup. Then later on after the closing bell, a company that has given you a forward look, United Airlines. This was the first industry to come out in the first quarter and say, Lisa, you know what? things aren't going so well.
And it's not going so well on domestic travel. Very interesting to see whether international travel also taking a hit inbound from overseas to the United States. We are hearing anecdotally that a whole host of non-U.S. travelers are not coming here for vacation, particularly Canada. They are taking their business elsewhere. This is going to be a big question, though. How do they get ahead of this? Do they buy back their shares? Do they cut their flight routes so that they can increase prices or keep prices the same? How much of an offset do they get from lower energy prices? In other words, companies adapt and adjust. How do they plan on doing it?
There's a great line on Wall Street that you can stop panicking when officials start to. And I'm not saying the White House is panicking. I'm not saying that at all, because they're showing no real sign of that. But in their actions, they are concerned. The very fact that we have exemptions now for certain industries, the very fact that the president is now considering some kind of relief for autos, and at the same time you have finally a Fed official that's willing to say, you know what, I would front load rate cuts if this economy started to roll over.
That's been enough to get stocks back to less than 5% below where they were on Liberation Day. That gives you a sense of how much we've retraced the volatile ups and downs that we've gotten during the whipsaws of policy over the past week. A real question here about how much support that actually is at a time where we haven't seen or projected the hit from possible consumer retrenchment, and that is something that is impossible to predict.
For now, at least, it's helping to stabilize the bond market. The 10-year at the moment yields just about unchanged, 4.38. Coming up this hour, we'll catch up with Alessio De Longis of Invesco as stocks look to build on a two-day winning streak. We'll catch up with Adam Hodge of Bully Pulpit International as President Trump considers more tariff relief, and Priya Misra of JP Morgan Asset Management as Treasury Secretary Scott Bessent downplays the recent sell-off. We begin this hour with stocks higher as the president considers temporary relief and temporary tariff exemptions for the U.S. auto sector. Joining us now to discuss, Alessio De Longis of Invesco. Alessio, it's good to see you, my friend. It's been too long. Let's take a giant step back. How have things been the last 4 months for you? How have things changed relative to how you started 25 compared to where we are now?
From a positioning perspective, we have entered the year in a defensive way, and I would say we were probably positioned defensive way too early. We went defensive towards the middle, late summer of last year. Clearly, that didn't play out across most asset classes in Q4, and really we felt validated more recently. Our process is really data-driven, and we have been seeing this weakening in the economy, a very gradual weakening, below trend growth, decelerating growth expectations, very demanding valuations not being really met by the performance of the economy. And now we feel that the price action have validated that positioning. Where are we today? Well, now we are in a place where I think now that the dust settles from a headline perspective and the confusion that this is creating, the economy is going to start telling us the truth. I think now it's about, well, we focus less on X headlines or true social headlines over the next 90 days. What is the impact on the economy? How much the private sector is going to begin to pull back while we still don't have clarity of whether the fiscal impulse is going to come and offset that. We have not certainty, but we have more clarity in Europe about the important, meaningful fiscal thrust that is going to come, supporting that area of the world. But in the US, we're now in a situation where the private sector is likely going to pull back as a result of all of this, and the fiscal impulse is definitely not what we expected in November with the result of the election.
If that begins to show up in the hard data, do you think, given the correction we've seen in financial markets worldwide, do you think we have the capacity to absorb that bad news?
I think you alluded to it earlier, we have a Federal Reserve that for the right reasons is saying, if I weigh in the impact on inflation and I weigh in the impact on growth, we don't really have a compelling case to support here from a monetary standpoint. And this is not a monetary fix. This is a fiscal fix, right? Tariffs are a tax. The only way to offset it is through an equivalent injection of impulse, of fiscal impulse. And it's not clear to me, we know that fiscal works with a very, very long delay. I think that we have an issue with valuations. I think we have an issue with the catalyst and the justifications for those valuations, especially in the US. They were completely driven by non-tariff related stories. It was all about nearly monopolistic conditions that US big tech used to have. Now we're challenging that assumption. So I have a difficult time seeing where the genuine new positive catalysts are going to come from over the next few months. Now, this is not a panic mode. This is one of, I think, where putting risk on in the market is really more thoughtful. I think the next leg higher is going to be led by non-US equities and international assets, including a big portion of dollar declines over the next few months and years.
I want to pick up on that. Christian Miller-Glissman of Goldman Sachs earlier laid it out as sort of three buckets of market action or market drivers right now. You've got policy uncertainty, you've got the structural cycle, and you've got the business cycle. You touched on the business cycle, the potential for watching that hard data. Policy uncertainty, a lot of people think that maybe we've seen peak volatility in headlines. That remains to be seen. The structural one, which you just referred to, how big of a driver is this shift away from U.S. dollar-denominated assets?
So by structural, let's put it into context. We're not talking about demographic type structurals, the productivity type structurals, so the 20, 30-year shock, but rather what is the next full length of a business cycle, the next 10-year cycle, right? And that is typically driven by these, you can see the data, this absolute highs and lows in dollar cycles, in relative equity performance between regions. I think the skew of probabilities is very clearly tilted towards a non-US cycle, non-US led cycle maybe after this recession, whenever that one will come, or sooner. What is the evidence for that? Valuations are the biggest driver of that 10-year plus horizon. Then we need a catalyst. We mentioned the catalysts there are a few. We talked about the rotation from growth into value, meaning the rotation out of the thematic big tech. There is an element also of just dollar valuations and the requirement, and the catalyst here coming from the new administration, regardless of whether we're going to have tariffs and how high they're going to be, regardless of how the negotiations go. But the byproduct of all of this is that this administration will not tolerate a deterioration in trade balances. So I'm not even talking about closing the trade balances, because that is simply not going to happen. The condition that satisfies all of these paths is one of lower dollar, right?
Well, so this is the reason why a lot of people are piling into this trade. Can you give me a sense of how much you have reduced your dollar exposure? Sort of where the dollar exposure has come from and where it is going in your recommended allocations from Invesco?
Only 3-4 months ago, we were a max dollar overweight, and steadily over the last 3-4 months, actually before this tariff event, we had neutralized the dollar positioning for the first time in several months. What the biggest catalyst for that change was, we are beginning to see, it's a reflection of where expectations have been. We're seeing positive economic surprises outside of the US. We've been seeing those steadily over the last few months. Now, remember, this has nothing to do with how strong the rest of the world is, but it's all about relative to expectations. The expectations outside of the US had beaten down so much that the bar for positive surprises has been very, very low, and they're now being met. The second has been this complete cyclical divergence in earnings revisions or earnings expectations. We have seen now, because of the fiscal impulse in Europe, earnings revisions really taking a leg higher outside of the US and a leg lower in the US. This cyclical divergence in earnings expectations and earnings revisions has been a big catalyst for that dollar unwind.
Can I ask you what kind of dollar we're going back to? Let's take euro dollar as a currency pair, for example. What kind of numbers do you think we're returning to?
So let's talk about economic metrics, the real economic metrics. When you look at purchasing power parity type of metrics, where relative inflation differentials, relative productivity differentials, the typical macro models are showing reasonable valuation levels for the euro at 125, 130. For the yen, similarly, 110 is still within economic fair values. And then currencies have a tendency to overshoot. So to answer your question succinctly, euro north of 130 over the next 3 to 5 years is really not a bold call in my mind.
So my trick question to ask graduates on trading floors, Ask them where they think euro-dollar was in the Eurozone financial crisis and the debt crisis between 2011 and 2012. And it was a band between 130 to 150. There was just this stubborn current account surplus driven by Germany that just drove this structural bid into the euro that eventually they had to fight in 2014 with negative rates. Are we going back to thinking about those kinds of themes, those kinds of systematic things, structural issues that drive the euro?
I would say so. Productivity differentials have not, despite what we talk about in terms of technology and US exceptionalism, when you look at GDP per capita growth and you correct for the fact that in the US we work a lot harder in terms of number of days, productivity differentials are not that different.
But Europe can't lose that access to the US consumer. That would be the issue I have with that. That worked in 2011, 2012 without aggressive tariffs from this president. With aggressive tariffs, I just wonder how that shakes out this time around.
The issue with tariffs is that I am wholeheartedly convinced, based on research I've done my entire career, tariffs, if they're going to have an impact on the trade deficit, it has nothing to do with relative prices. It has everything to do with the shock that they will have on US demand. What do I mean by that? The income elasticity, the propensity of US consumers to consume is twice as large as the propensity to consume by European citizens. So what tariffs will do in adjusting the trade deficit is most likely to bring in a meaningful downshift adjustment in US demand rather than impacting the relative pricing competitiveness between European products and US products. In a nutshell, euro higher, most likely through the usual channels. Much easier monetary policy in the US.
Okay.
Wider interest rate differentials in favor of the Eurozone, which as of today, we simply cannot even conceive, right? But if we do have fiscal impulse in Europe and a more meaningful downshift adjustment in the US, yield differentials much closer to a strengthening euro.
Alessio, appreciate your time. Lots to think about. Alessio de Longestette of Invesco. Lisa, euro dollar at the moment, 113.36. I'm still trying to think about this, what it means for the ECB. There is another world that if they have to absorb all the other capacity out of China, where they have to actually cut rates aggressively in Europe too, in response to that.
If they have a strong economy, though, it could go the other way. The tail risks have just gotten a lot wider. And for Europe, it had always been a slow growth kind of paradigm. To Alessio's point, yields were always going to be lower than the U.S. Well, is that going to be the case anymore if that's where the growth ends up being driven from in some capacity? I'm not saying it is, so before I get hate mail, but that is sort of...
You got hate mail this morning.
I don't know. I imagine I'll say something like that, and they'll say, are you kidding me? We're coming off such a low growth base, and where is the tech investment?
No one knows anything.
You know, no one knows anything. That's
no
a good
one knows
news.
anything.
Thank you. Mm-hmm.
Euro dollar, 113.36. I'm not sure anyone can insult you with any conviction whatsoever.
Oh, they still will.
You know.
It's fine. I welcome it.
Let's get you an update on stories elsewhere. With your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. Just a relook at Bank of America earnings. Those shares higher by 1.8% in the pre-market, beating estimates on total trading revenue and net interest income. With the Wall Street trading bonanza continuing, CEO Brian Moynihan expecting a, quote, changing economy in the future, but adding that consumers are maintaining healthy credit quality. Elsewhere in earnings, Johnson & Johnson beating expectations and maintaining its earnings outlook. Shares are lower by nearly 0.9%, weighing on the industry. The Trump administration's probe into drug imports as it plans tariffs. Johnson & Johnson CFO sees the investigation as beneficial, though, saying that it might show that most drugs imports are cheap generics. Elsewhere, Harvard University has rejected demands from the Trump administration to combat anti-Semitism, citing threats to its independence and constitutional rights. In response, the federal government will freeze $2.2 billion in multi-year grants to the university. And that's your brief, John.
Danny, thank you. How could anyone insult Bremo? We all want the answer to that. How could they?
Very, very easily. It's okay. I welcome it. But
Brutal.
I'm just saying there are other arguments. I'm recognizing them.
We're all open to other arguments. Up next on the program, possible tariff relief for autos.
I'm looking at something to help some of the car companies where they're switching to parts that were made in Canada, Mexico, and other places, and they need a little bit of time.
Up next on the program, Adam Hodge of Bully Pulpit International, live from New York City this morning. Good morning.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Equity futures just about positive by 0.1% on the S&P, on the Nasdaq 100 up by 0.15, on the Russell just about unchanged. And the surveillance this morning, possible tariff relief for autos.
I'm looking at something to help some of the car companies where they're switching to parts that were made in Canada, Mexico, and other places, and they need a little bit of time because they're going to make them here, but they need a little bit of time. So I'm talking about things like that.
So here's the latest this morning. President Trump exploring possible temporary exemptions for imported vehicles to give car makers time to set up U.S. manufacturing sites. Bloomberg's Tyler Kendall joins us now for more. So Tyler, help us understand what they're considering here and how much time they'd be given.
Yeah, hey, John. So President Trump did not specify exactly what products could see the short-term exemption or what timeline he would implement it under, but he did indicate that he is considering a short-term exemption for car makers, particularly when it comes to those that are moving auto part production from Mexico and Canada to the U.S. As you know, there's already that 25% tariff in place for fully assembled autos, but as of now, we're still waiting for the auto part tariff to go into place. That's expected to happen by May 3rd, and part of this is because the U.S. has said that it will only tariff non-U.S. content within those auto parts. But it is starting to prove a little difficult to discern between what is non-U.S. content and U.S. content, considering that the supply chains across the borders are just so highly integrated. Now, we know that the big 3 autos in particular have been lobbying this White House. People familiar with the matter do tell Bloomberg News that these auto companies are prepared to accept a tariff on fully assembled vehicles as well as larger auto parts like engines or transmissions, but that they really are pushing for exemptions when it comes to those smaller auto parts. We'll have to see where these negotiations lead, as President Trump, you heard him there, sort of opening the door here to talk particularly with the private sector. And it comes, as you well know, John, that he's also opening the door to potentially other exemptions when it comes to other sector-specific tariffs we're expecting to see. He said the other day that he would be interested in looking potentially into exemptions on chip products as the administration formally launches its Section 232 investigations into chips and pharmaceuticals.
Tyler, appreciate it. Tyler Kendall down in Washington, D.C. Automakers rallying in the last 24 hours on both sides of the Atlantic, Lisa, not just the U.S., but also in Europe. Volkswagen up in today's trading.
They make a lot of parts in the U.S. and they make a lot of cars here. They actually export cars, BMW in particular. So you have to wonder exactly what we're trying to get at and who's getting penalized. All of a sudden, it's a big breath. Let's take some time.
Let's take a deep breath right now and have a conversation with Adam Hodge of Bully Pulpit International. Adam, welcome to the program, sir. The administration, for a lot of people, have correctly identified the issue in the U.S. economy. Where people disagree is the execution and approach of the last few weeks. What kind of approach would you like to see the White House take in the months to come?
John, look, I think you nail it right on the head. There's no question that for many of the challenges that we face in the global economy, Trump does diagnose the problem. The problem is the execution, the solution that he puts on the table, right? I mean, broad global reciprocal tariffs are not going to address the bigger challenges that we have in the global economy, from China's dumping and overcapacity of autos and steel and a bunch of other sectors around the economy. So they have diagnosed the problem. They haven't quite gotten to the solution. And the thing that I keep coming back to is the pullback on domestic investments, right? We, in the last few years in the Biden administration, made a bunch of investments in key sectors. Yes, semiconductors, steel and aluminum, try to do a deal with the Europeans on that. That was all to try to help reassure the domestic manufacturing capacity here in the U.S. with our partners coming along for the ride. Now you've stuck a fork in their eye, and I don't think they're going to be all that excited about doing deals or trying to find other ways to address some of the bigger fundamental problems that we have.
Adam, why have those investments not done more to reshore production in the U.S.?
I mean, I think there's one element that it just takes time to get money out the door. So, like, you have seen a coupling of both investments and tax incentives, and you did see a whole bunch of investments across the country in the last 4 years. SK Hynix, right, invested a huge battery facility in Georgia. A bunch of TSMC in Arizona, right? Those deals were announced, those investments were being made, and it does take time for those things to come into action. I think what you are looking for what companies and what we're hearing from our clients is just more certainty. They really want to get a sense of where are things headed and how do we adjust and address the challenges that we have from the Trump administration.
How much bipartisan support is there, Adam, for some level of tariffs to encourage or expedite the system of reshoring, given the fact that some of the tariffs put on under the first Trump administration remained under Biden?
The tariffs did remain, but I think you're getting to a larger point here, Lisa, right? Like, any of these sort of 90-day deals that we could expect from foreign countries are going to require Congress to pass legislation. Any adjustment to tariff rates and taking lower tariffs from other foreign countries requires an act of Congress. In this environment, I'm deeply skeptical that you're going to get 60 votes in the Senate and bipartisan majorities for huge tariff increases, right? I mean, USMCA was unique in that there really was give and take from Democrats and Republicans. The Trump administration did engage Democrats on the Hill to try to get a deal that also had, just the labor and environmental issues. That was part of a framework. You poison the well. I think it's really hard to see any type of bipartisan agreement for a congressional action in the next several years.
Trade deals are tough. They're complex. Adam, appreciate your input. Adam Hodge there of Bully Pulpit International. It's going to be a very busy negotiation period for this administration, but to make trade deals happen, it's very difficult. Ask the UK post-Brexit. It's very hard to make it happen.
Especially given the 90-day window. Then on top of that, months-long investigations, the different timetables of all of these different tariff regimes, these tariff buckets that we have, very hard to keep track of. If someone has a flow chart out there, please send it over of all of them and that is editable in Google Documents. I think that could be really helpful.
I'm attempted to make it very simple. Focus on one relationship, the US and China, and focus on a consistent message coming from the Treasury Secretary. He wants the Chinese economy to rebalance towards consumption and away from exports. The issue they've got right now is China's not negotiating. They're not coming to the table. We're not seeing that at all.
And we don't have a sense of where the leverage is right now, given the fact that China doesn't necessarily have to worry about the pain inflicted on its people in the same kind of way as, an electorate.
No elections. Equity futures right now in the S&P, positive by 0.1%. Up next, Gil Luria of D.A. Davidson.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings stick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
The opening bout is about 2 hours away. Equity futures on the S&P 500 doing okay, up by 0.1% on the S&P, up 0.2 on the Nasdaq 100 as we attempt to wrap up earnings season on Wall Street. Let's get you some movers with Danny Berger. Hey, Danny.
Hey, John. Another bank earning another record haul for equities trading, this time coming from Bank of America. Shares up 2.4% in the market trade. Not only was the equity trading strong, it also beat on net interest income, with the bank citing a consumer that is resilient and healthy, so its loan loss provisions also lower than expected. To the downside this morning, Boeing shares are falling in the pre-market trade, down more than 3%. A scoop from the Bloomberg team that China has told its airlines stop taking Boeing deliveries, a change in the trade tit for tat that focuses more on individual companies than overall levels. And also not just halting deliveries from Boeing's, but U.S. part suppliers, so companies like Howmet also falling in the pre-market trade. Wrapping things up with Netflix, this from a late in the day Wall Street Journal story yesterday, shares up 2.33%. That Netflix has set itself some very, very lofty goals, maybe showing some confidence from the executives there, that by 2030 they want to double revenue and reach $1 trillion in market capitalization. They think they can do that. Again, it is a big ask considering market cap at the moment just below $400 billion, John.
Danny, thank you. The latest there on Netflix. Danny mentioned Bank of America. Let's talk about that. On our radar this morning, Bank of America beating estimates on total trading revenue and net interest income as Wall Street continues its trading bonanza. The CEO, Brian Moynihan, expecting a, quote, changing economy in the future, but Lisa adding that consumers are maintaining healthy credit quality.
Yeah, and in some of the further commentary that we're getting, they just double down on that. They haven't seen deterioration. It has continued to be strong, which raises the question of how much they are seeing or sensing out or not some of the deterioration in economic trajectory in the United States that a lot of people are expecting. Again, these banks were supposed to be conservative. JP Morgan set the tone by increasing their loan loss provisions. That's not what we're seeing from any of the others, and that's not really the rhetoric we're hearing either.
I can't predict the future. We won't pretend to. We don't have a crystal ball. But if you want to assess risk, if you're in the business of doing that, which most of you are, you've got to understand where we are and how resilient corporate America might be going into a downturn. And what the banks are telling you at the moment, the banks are telling you they're in pretty good condition and they might be able to weather a storm if there is one.
So why is there this dissonance? And this goes to the soft data, hard data debate, which will be a theme for the rest of this year, I expect. But you go to this question, why are people feeling like 2008? Why are people feeling like 2000? Why are people feeling like the last crisis, 2020? Those are all of the metrics of sentiment. Why are we getting those types of metrics? If you're looking in the data, they are still spending. Companies are still seeing plenty of activity and people paying their bills.
Do you think we'll have a different tone later on this afternoon when we get earnings from United Airlines?
Perhaps. I think that that's the expectation. That said, how much do companies have the ability to adjust and how much are people still flying, just maybe marginally less? Remember, Delta gave a pretty negative outlook, but it still was coming down from a very lofty level, and it wasn't going down to that kind of horrible level. It was just going down to something that was more reasonable rather than the revenge travel that everybody did when they were sick of being home in their
I have to admit, I'm pleased we're past that because that was brutal. Traveling wasn't nice.
Wait, what are you talking about?
Going to the airport was like going to war. Everyone was out for each other. It was brutal.
Gate lice?
You liked that?
Well, love
tone
gate
in
lice.
the airport
No,
travel, the
look,
way they
you're
treated
right.
you. The
Okay.
airlines were awful too.
I understand. People were crowded. They were desperate to get their revenge travel on. I think things have calmed down, so maybe you'll enjoy traveling again.
Sit on the plane, they'd bring some food and slam it down on the table.
Well, I don't know what airline you're traveling on, but my airline doesn't do that.
Another time. It wasn't my airline. It was another airline. It wasn't your airline either. And there's only one other airline, so figure it out. You know the answer to that.
Mohammed?
Okay. Bank of America right now is positive by 2%. Certainly wasn't Bank of America. They treat you very well. Equity futures on the S&P positive by 0.1%. The president considering possible tariff exemptions on imported cars to give auto companies more time to set up U.S. production. This is the White House initiates probes for pharmaceutical and chip tariffs. So given with one hand and maybe taken with the other this morning.
So it's the idea of trying to make a big statement on one hand and then try to reassess and put some time between here and there. How do these negotiations go? I know that Scott Bessent, the Treasury Secretary, is going to be meeting with